What's up traders, and welcome. Finally we are here to share a strategy that statistically works and with which you can actually get great results in the market. Now I'm here to finally share this strategy completely for free. I'm tired to see of all these gurus online on social media, whether it is Instagram, YouTube or any other social media, that just want to talk about psychology, they want to talk about strategies but never had some real results. Now I've been a trader for 9 years, almost 10 years by now, and I've achieved great results. I would say I didn't make 10 millions with trading, but I went from $20,000 in debt to making more than $500,000 with trading and using that money to compound it into other businesses like my own prop firm, which is GoFund Trader, like my real estate business. I currently own 7 real estate properties and soon I'm planning to actually buy some land and move into the land type of investments, and also other projects that you might know already. With that being said, it's really time to share this strategy, to share this trading strategy, which is the trading strategy that allowed me to go from $20,000 in debt to more than $500,000 in profit. And I want to do this because I believe that this strategy will be helpful whether you are a beginner, whether you are an intermediate trader, or whether you are a professional trader with already good results. And the reason why I say this is because if you are a beginner, you need a strategy. You need a strategy that statistically works and with which you can get great results. And this strategy statistically works. If you're an intermediate trader, you might need to increase your accuracy. Maybe you are getting there, maybe you are getting okay results, maybe you are already slightly profitable, or maybe you are about to be profitable. But this strategy will allow you to really skyrocket your trading results and to actually understand which concepts you're missing in order to get profits. Lastly, if you are a professional trader and you are already getting great results, but maybe you want to increase your accuracy, maybe you want to make more money, maybe you want to be more accurate, maybe you want to increase your risk to reward ratio, this video is still for you because you can take some concepts from this video and apply them to your own strategy in order to increase your accuracy. So with that being said, let's get started. Now let's start with the first video talking about the colors and the chart settings that I use. Let's start from the basics and let's actually put a clear picture together on which charts I use, how I use them, which colors I use, why I use them, and all of these things that might help you just get started with the first tools on TradingView. Now before moving forward, I just want to let you know that you can get funded up to $800,000 with GoFund Trader. Here below there is a promo code here in the description. You can get 10% off and get access to bigger capital, because usually the problem with traders is that once you have a profitable strategy, and a profitable strategy might even be a strategy that makes you between 2% to 15% a month on average, then you need bigger capital. Because of course, if you're making 10% every month on a $100 account, it's not going to be great results. But in a percentage point of view, 10% is huge. 10% every single month is some huge percentage. Now, if you can make that 10% on a $100,000 account, or maybe on a $800,000 account, which is the maximum allocation with GoFund Trader, think about it. Think about the income that you will have with the same exact percentage. Now, in order to get to that percentage, you need to practice and you need to see actually which accuracy you are having right now, which accuracy you are having, in which areas you need to get better, which pairs are your best performing pairs, during which days you are the best trader and during which days you are a bad trader, you know? Now, do all of these things on MTJ software. MTJ software is a journaling, analytics, and backtesting tool, completely automated. You just sync your account, you just do some backtesting and it completely automatically gives you your statistics. Now, I'm not here to try to sell you this, and for this reason, you can just have 1 month for free here below. So use the link here below, use the promo code that you will find. You can have access for 1 month for free, and then if you want to continue, of course, it's up to you. But I recommend you to use it to really see your statistics and to see how to improve it. It will tell you right away in which areas you need to improve. Let's get started. What's up everyone? In this video, I will show you which tools and also the terminology that I use on my charts, so you can get used to seeing my terminology, my colors. You can decide if you want to use my same colors or if you want to use different stuff, but at least you can understand what's going on and you can get used to the analysis that I am doing. So let's start from the boxes for supply and demand levels and other stuff. So first of all, There is the HTF-OB, which is higher time frame order block. It means that it's just a higher time frame, either 4 hours or 1 hour order block, which is just supply or demand level. So for example, if I want to take this one as my area, I will put the box and put the higher time frame order block and drag it out. And this is my higher time frame order block. Now, if I go on lower time frames, for example, 15 minutes, and I want to refine this level, and for example, I refine it to, let's say, just this area, and of course there is a refinement down here too. I will put the box and then ref as it means refinement. Okay, and then drag it out. Okay, so these are the two boxes for the supply and demand levels. Sometimes when I'm on lower time frames, like 5 minutes, 1 minute, I just use the Excel block in order to just depends. Sometimes I use the refinement, sometimes the Excel block, just what is better for my eyes. Then we have the retail level. So for example, if let's go on another pair. As you know, majority of traders, well, not majority, but many traders are using support and resistance, and we want to identify those areas to consider those areas as manipulation areas. So I will draw my box, and this color is my retail level, which can be targeted as there is a lot of liquidity below this level. As you know, traders will try to buy and buy and buy at support, and then finally we just smash through it, getting all the stop losses. So this is my color for the retail level. Then let's see what else. Then we have imbalance. Okay. Right here, imbalance. Sometimes I drag it out, sometimes I just leave it like this. I just need to know that there is imbalance at a certain level. Then we have AR. AR means Asian range. You will see during this course how the Asian range is used. So here we have the Asian range. Sometimes I don't like to keep the indicator for the Asian range, and I just draw my box from the top to the bottom of the Asian range, and I put AR, and so I can take off the indicator and I just have my Asian range right here. Then the last thing that we have with the boxes is for lower time frames confirmation. So for example, if you're looking to enter a trade because we are at a higher time frame order block right here from all the way back on the left, I will look to use some confirmation. For example, this will be my SW, which is switch of, just switch, it's just my terminology, how I use it. This will be all explained during the course. Don't worry how to use it, how to find confirmation. And this is my LMS, which means last man standing, which is the final confirmation to actually enter the trades. Now, all of these will be how to use it, how to use these areas will be included. Right now, I'm just showing you the colors and the boxes so you can get used to it and you can understand the terminology. So these are all the boxes. Then we have trend line. I have the trend line as liquidity. So if you see the dollar sign is liquidity, then I use the trend line as equal lows, still for liquidity. So equal lows, same thing for equal highs. If we have equal highs somewhere, let's see. Sorry, that's my cat. Anyway, if we have equal highs, well, we don't, let's pretend these are equal highs, then put equal highs, still means liquidity. Then I have the partial here, which just means I put it on the chart when I have like a trade running and I take partial profit, I mark where I'm taking partials. And SW is the same thing as this one, just with the line. So it's the same exact thing, means the same thing. And then of course, break of structure. So when the market is moving and we break structure in direction, for example, here right now, if we have a push to the upside, we are breaking structure and I will put boss break of structure. So these are the lines that I use. Then I use just this stuff for educational purposes. Let's see, also these just educational purposes, brush to educational purposes, call out when I need to write something, but still educational purposes, text, same thing. Here, this gives you the set price of where you put it. So if I put it here, it's a price. If I put it up here, it's another price. If I put it here, it's another price. Could be helpful. Sometimes I like it to put it on charts. And then I have take profit and stop loss. Sometimes you will see me use these colors, which are the basic ones. Sometimes you will see me use a different color, which is this one. There is no difference. Sometimes I just like one, sometimes I just like the other one. There is no real difference between the two. Last thing is my fib levels. So again, they will all be taught during the course how to use them and so on. We have my fib levels for entries. These are actually used for entries. Then we have the 0.5 fib retracement, which is just used to identify premium and discounted areas. These will be explained during the course, don't worry. And then we have the Asian range projections. So I was showing you the Asian range earlier. Let's delete everything and let's show you the Asian range. Okay, there we go. I mark the Asian range with my box from the top to the bottom. I put AR, I delete the indicator, and then I can use the projections and you will learn how to use them during the course again. But these are the projections of the Asian range, okay? All right, then which indicators I'm using? As you know, I'm not using any indicator to actually trade. I use them only to backtest and so on. So for example, this right here is just an indicator that separates days. As you can see, Monday, Tuesday, Wednesday, Friday, and so on. Also separates week. This is the line when the week ends. So just understand when I'm backtesting which day something happened, and maybe I can notice some things that happened maybe on Friday or and so on and so on. You will have all informations during this course. Asian range, you saw that already. Sessions just separates the sessions, London, New York, and Asia. Again, I only use it to backtest. And kill zones is just my favorite trading hours, London and New York Open, and it is marked this way, as you can see. London Open, New York Open, I like to trade during these areas especially. So these are all my tools. Maybe sometimes you will see me use something more, but these are the main ones that I use and that you need. Now for the colors of the chart, of the candles, these are the colors, blue and black, but sometimes you will see me use these other colors, just the normal ones, green and red. Again, here just depends on what I like at the moment. I don't use any other color. I only use the normal ones, which are these, or the blue and black ones. The reason why I don't change them to other colors because my eyes need to get used to seeing a certain color, and with time this will help you. This increases your accuracy. I know it sounds crazy, but it does. If you get used to seeing the charts with certain colors, your eyes will get used to seeing certain things. Thank you for connecting. Let's continue with the course. If you have any question, feel free to ask me. Now we just got done with the first video. It's time to move to the second video, which is about Fibonacci tools. Fibonacci tools, which actually I use in two different ways. Sometimes I use them to actually have entries, so with a different Fibonacci setting, or some other times I use it with the 0.5. The 0.5 setting allows you to see premium and discounted areas, and based on this you can see actually in which areas you will be interested to actually enter trades and in which areas you will never be interested to actually enter trades. So let's get started with the 0.5 Fibonacci settings, which will actually help you, and we'll put all of these pieces together at the end, and we'll also have some trade breakdowns so you can actually understand how to take all of these pieces and put them together in order to really get results in the market. Hello everyone, in this lesson we will talk about the 0.5 Fibonacci level and how to use it, why it is very, very important, and also how I'm using it with this strategy that I'm teaching in the course. Now, keep in mind that if you see my charts with the 0.5 Fib level, it doesn't mean that we're not using our usual Fibonacci levels. They are just used for different purposes. So our Fibs are more used for entries and to find possible entries if there is confluence with a supply or demand level. So for example, right here we have gold for hours, Fibonacci levels, then we have demand, and we could target this demand, which is slightly lower than our Fibs, in order to enter and continue if there are all the confirmations that we need, of course. Now, why do sometimes you see me use the 0.5? The 0.5 is used for different purpose. Now, keep in mind that, as I said already, my Fibs are used drawing them from the bodies of the candles. So this is, always remember this. While the 0.5 Fib, you just need to go here and just put the 0, the 1, and the 0.5. You can put my same color, you can put different colors, you can decide. Now, the 0.5 Fib is used for a different purpose. And first of all, we need to draw it from the wicks. This Fib is used to understand if we are in a discounted or premium area in the chart. What does it mean? It means that, for example, in this chart, we have this push to the upside, and this push to the upside has a discounted and premium area. In this case, this is the discounted area, so below the 0.5 is discounted, and up here we have the premium area. Now, if we are looking for buys, so if we want to follow the trend and we see that with our overall analysis, we have a breakout structure to the upside and we want to find demand areas where to buy, then we will avoid looking at all demand areas that are not at a discounted area. Just like when you go to the store, you want to buy discounted stuff. In this case, you want to buy at a discounted price. So here we have this demand, we don't care about it. We have this demand, we will not look for buys at this demand. While down here, we have this demand and a lower demand. And these two areas are the ones that we will take into consideration, while these two, we just don't even take them into consideration. Now, for more advanced traders who are getting used already to using the 0.5, who already know how to trade these setups when we come back to the discounted area and we have a good demand, they know how to wait for confirmation and so on and so on, and it becomes kind of routine. You can keep in mind that once we are on a premium area, usually the price tends to come back to a discount. So here you could look for counter trend trades, which of course are lower probability and therefore you should go with lower risk. But if you have the confirmation, you can go with counter trend trades targeting a demand at a discounted area. So for example, we are up here, you have, let me go on the chart, we are up here, you have this demand down here, which is at a discounted price. We are at premium. If we have a confirmation that we are reversing from the premium area, then we can target this discounted area and a demand at a discounted area in order to enter our sales, because price tends to come back. Now, other than the more advanced stuff, let's do some more examples on premium and discount. So, for example, let's go to the 1 hour. Oh, right now is not really, let's go back here, since right now is kind of ranging and not really trading with momentum. So here, for example, we have this push to the downside, okay? Push to the downside right here. We don't know where we want to sell at this area. We draw our premium and discount from the wicks. Keep in mind from the wicks in this case, not the body. And well, and then we go to lower time frames to possibly look for an area here. So in this case, we have this area. We come back to premium and we come back down. Here there is no supply, so of course there is no entry, but I'm just showing you we don't want to enter any sales at a discount in this case, because right now we're looking for sales, and therefore for sales we're looking at premium and not at discount. Okay. So when you're trying to sell something, as an example in real life, when you're trying to sell something, for example, you buy a watch, an investment watch, you buy a Rolex, and you want to sell it later in time for a higher price. When will you sell it? When the price of your Rolex is at premium, which means that maybe you bought it for a lower price, price went up, we are at a premium price, so the price is higher compared to where you bought, and therefore you are looking to sell at that area, at that price. Same thing for Forex. Right here, we're not interested in selling at discount, we're interested in selling at premium. We come to premium, we don't mitigate the supply, and we just go down, but you get the point. We actually rejected from this area, which is an area that I don't consider on my trading plan. I just prefer trading with supply and demand areas. And of course, these we didn't reach the 1 hour. We didn't reach the 1 hour supply, but we did reach the 4 hours. If we check the 4 hours, it was just probably a bigger area, yes, and therefore we actually reached that. We went to the downside. And if we were trading with 4 hours supply, then we would have considered this already. And then we go to the 1 hour, which is what we do usually, what I do. So we have this 4 hours area, then we go to the 1 hour and we refine it to the last up move before the down move. So this is refinement. Of course, I always prefer to see the higher area to be reached, but of course you need to keep in mind that if you have a very good confirmation, which I believe that I see right here, because I see a small consolidation push to the upside for liquidity and continuation to the downside, then that's good. If you want lower time frames, that's probably what you see. And later on the entry types video, you will see this, but I'll show it to you since we are here. So consolidation, push to the upside, change of direction to the downside, retracement, and we're looking to enter at same thing at premium. So it applies both for entry confirmations and also for overall analysis on higher time frames. And as you can see, we are not selling right here, we are selling at premium. So you're not interested in selling down here, you're only interested in selling at premium. So both for entries on lower time frames and for higher time frames analysis, okay? But later we will see, of course, in the entry confirmation video how to do it. Then let's keep going. We have, okay, same thing, push to the downside, premium and discount. We're not interested in selling anything down here. We are interested in selling up here, okay, same thing. So this allows you to already eliminate some supply and demand areas in which maybe you're not interested. Same thing here, GPCHF, 4 hours. This is the overall down move, the direction of the market started from up here and just went down. We draw discounted and premium area, and you already eliminate that. You know that you will not sell or even look for sales at this area. You already eliminated that area, but you know that you might consider this one, you might consider this one, you might consider all of these, actually, this one too, etc. But at least you eliminate part of your supply and demand areas just by looking at premium and discount. Now, in this case, here we had the breaker structure. Therefore, we know that this area, which is the area before the strong breaker structure with strong momentum, could be a strong area to consider. Now let's keep going. Okay, your CAD. Your CAD, we have this move to downside, and we are looking to sell at premium. So either here or also here is not bad. This depends. I'll also talk about the analysis, not only about premium and discount. So we just know that up here above the 0.5 is premium. Right now, we also saw that there was a breakout structure to the downside, not very strong because we just stopped below it. But we know that we are either going to sell here for continuation to the downside, or we have liquidity of these two highs with an unmitigated supply above it. So we might consider that one if we go higher. But you will see this in other videos. I'm just showing you since we are on charts and we talk about it since we're here. Not only showing you the premium and discount. Same thing right here, and this applies for both buys and sells. Whether you have a buy bias or a sell bias, it applies to both. For example, here we had this push to the downside. This is a trade that I missed. In this case, it didn't hold the premium and discount, but this will help you a lot because it will add a lot of accuracy in your analysis. So, for example, here I had a lower time frames confirmation already. And you will put all of this together when you will see the lower time frames confirmation. I had this break to the downside for lower time frames confirmation. We draw the premium and discount. We come back to premium, supply at premium, perfect continuation to the downside. Okay. Now I was on high time frames, and we actually had I missed that entry. We had a deeper movement, and then I was waiting for this high to be considered as liquidity, price reaching premium, this supply area which was not mitigated for continuation. In this case, it didn't play out, but always keep in mind, and I will write this down because it's very important and some people don't understand it right away. Just because something happens once or sometimes, it does not mean that you are changing your strategy and plan. What I mean by this? By this, I mean that if you go on charts, sometimes you will also see trend lines be respected. So for example, there is a clear uptrend. We draw the trend line. We know that the trend line is liquidity. Maybe we want to see liquidity taken to reach this demand area to then continue to the upside. Maybe we are also the overall move. Our area is also at a discount, so perfect. And it just doesn't happen. We come here, we respect the trend line, we have a huge move to the upside, it just doesn't happen. Sometimes this will happen and you'll be like, oh, then maybe it doesn't work. No, this is not how it is. The majority of the times you will see the discount and premium area to really help you with your plan, to really help you with your entries, to really help you selecting the supply and demand areas which are better and which are better to avoid. But just because sometimes you will miss entries, like me in this case, doesn't mean that next time you will come here and get this entry that this is what happened later. Doesn't mean that you will do this, because usually we manipulate the high to reach a premium or discount, in this case premium, and then we go down, we mitigate supply, and then we go down. Same thing, usually trend line builds liquidity. Usually we have the run of liquidity, and then we go to the upside after reaching a discounted area and demand, okay, unmitigated demand, and then we go to the upside. But sometimes, not very often, but sometimes you will see just the trend line be respected. And if you think about it, this is why there are traders still trading with trend line, still trading with random entries. And this is why they're not profitable, because if you think about it, and this is where I was too about 7 years ago, Sometimes you have your nice trend line. You see the first touch, second touch. We are here, we're coming back. You want to enter at your third touch, and it actually holds, and we go to the upside, and I used to win some trades doing this, of course. But think about it, there would be no traders trading with trend line or support and resistance or with premium, or with these things if this never holds. Because if it just never holds, of course traders will stop using it. But the reality is that sometimes it does hold, and for this reason traders still use this and still use this way of trading, because sometimes it holds. So they see that one time or two times it works, they be like, oh, therefore the trend line works, the support and resistance works, and then for 5 times in a row they lose money. So of course, to make retail traders lose money, sometimes these patterns need to hold, but we don't want to trade them just because they hold sometimes to trap retail traders. Okay, this is very, very, very important to keep in mind. So even if here we missed an entry, next time I will look for the same exact thing. Okay, let's keep going. Okay, same thing, Euro JPY, premium and discount. Okay, keep in mind that if you have confirmation, like down here, I will show you the confirmation to go for buys. If you have confirmation and you are at a discount, you can look to counter trend trades to the premium area, okay, targeting premium, and vice versa. If you are at premium, you can target the discount area. Now, I'll show you the confirmation here, and then I'll talk about this. Confirmation here is simply supply areas failing, as you can see, and this is the demand that failed that area. We come back to demand, and then we continue to the upside. Here, down here, we could have had some confirmation, probably this move to the upside. Move to the upside breaks the previous highs. We come back to demand here, and then we continue. Okay, but other than that, which is not the aim of this video, in this video we're talking about premium and discount. Later you will understand better the entry types and all of these confirmations. What I was trying to say is that so usually what we want to do is that we have a downtrend, we have premium and discount, and you just want to wait for your retracement to the premium area at a good supply. Maybe there are more, but at a good supply where you will look for confirmations. If there are more supplies, you will look for confirmation, and you enter where you have confirmation, come back to then look for sells and continue. Same thing for buys. Premium and discount, in this case, this is an uptrend. We want to buy at discount. We don't want to buy at any area here. We find our demand. Maybe we have 2, as I was saying. You wait for the price to come back. Maybe here it doesn't give confirmation. Down here it does give confirmation. Okay, and then we look for buys. Now, for more advanced traders, this is not what I really recommend. If you stick to your plan and do this, you really increase your chances. But if you're really comfortable doing, you're a good trader, you're already profitable, and you want to start working on some other concepts that still work, but maybe you go with 0.5% risk instead of 1%. Okay, you understand what I'm saying. You go with half risk, you don't take too many positions of the type that I'm about to explain to you, then it could work. These are the best ones. Now, if you want to counter trend, what I was saying is, let's go back. Okay, so right here, you are at a discount, but we are in a downtrend. So if you enter buys, you will go against the trend. Okay. Now, since you are at discount, this is the only thing that allows you to actually believe that we could have buys opportunities. So at discount, we want to buy, as we were saying, but we want to buy better if we are in an uptrend, we pull back to discount and we continue. Not if we are in a downtrend, we are at discount, but we are in a downtrend, okay? With that being said, as I was showing you on EuroJPY, if you have lower time frames confirmation, which in this case, there could be many, but in this case on EuroJPY was supply failing and therefore demand being in control, retracement to demand to continue to the upside, you could target you could enter with the right confirmation against the trend in order to target your discounted area where we will continue with the trend. Okay, so you target premium, and in this case, at premium, you target discount. But keep in mind, this is more advanced. This is not where you should start from. This is just a lesson for more advanced traders that will find confirmations from here. Here, for example, we have a consolidation, we have run on liquidity, change of direction, okay, confirmation, we reach supply. Here, this is the change of direction, okay, and everything, break of structure, and we target discount. We enter cells to target discount, okay, knowing that we are in an uptrend and that from here, either this area or this area, we look for buys because the overall trend is to the upside here and to the downside here. I'm just showing you the options to actually counter trend. You just want to keep in mind that if you want to go against the trend, you need to be in a downtrend at discount and in an uptrend at premium. If you want to go against the trend, which is not the best option, you should go with half risk. Well, of course, these are not financial advices, but you understand what I'm saying. Well, if you actually want to go with the trend and play with normal risk instead of going with half risk, then here, push to the downside, you wait for your premium area, supply, push to the downside, okay? Here is the perfect example, EuroJPY, premium and discount, move to the downside, premium and discount. From up here, we're looking to sell. But from down here, we had confirmations, as I showed you earlier, just go back in the video, for buys to target this area, okay? Let's see some other examples. I had some good examples here. Okay, perfect. This was a trade from a while back, premium and discount. So we are not interested in anything down here. Actually, you can counter trend from here, which is not something that I did, okay? Keep that in mind. Then you have your supply here and supply up here, okay? Here, we just go straight through it, okay? Here, we just don't even stop, we just go straight through it. Here, up here, we reach the supply, we go on lower time frames and we had confirmations, which is the usual confirmation that I will explain in the confirmation video, just consolidation, push to the upside, and continuation to the downside. And the continuation to the downside, without going on lower time frames and messing up the chart, as you can see, I drew the premium and discounted, and I sold from the premium. So same thing on lower time frames for confirmation. When you have this, when you have your schematic, I will show you, of course, better on the confirmation video. Premium and discount, you're not interested down here, but you are interested up here, okay? Very, very important. So premium and discount, both high time frames direction, lower time frames confirmation, both. For high time frames, what I'm talking about is, for me, you can use this on the monthly, on the weekly, on the daily, all the way down to the 1 minute for confirmation. Now, my plan, as you know, I start from the 4 hours, then I go 1 hour, and then I go lower time frames. But for direction, so let's say direction, premium and discount, 4 hours, premium and discount is this. Then I go to the 1 hour, and it's the same, of course. This is the move to the upside. So we are right now at discount. Then maybe you go to lower time frames. You want to look for buys because we are aligned with the direction in the 4 hours and 1 hour. We had the move to the upside. We drew this, we came back to discount, and we are at demand. Okay, now what's missing? Entry confirmation. Entry confirmation, I was looking for this. We had push to the upside, breaking all the previous highs. I drew my premium and discount, and I had my demand be at the discount area, and we just didn't come back. So in this case, we didn't come back. What I'm looking for now is this. Let's look if it is acceptable. It almost is, not very, it's not perfect actually. It should be below. So this doesn't meet 100% the plan, okay? CAD-JPY. CAD-JPY is another trade that I was looking at. Actually, I am still looking at this trade. Move to the downside, premium and discount. Okay, so this could have been one opportunity, which was at premium, but as you can see, we just went straight through it. Then we reached the higher supply on lower time frames, and we have the confirmation that we are changing direction, as you can see. But again, the lower time frames confirmation video will be another one. Now, you draw your premium and discount on 5 minutes for confirmation, and you can see that here we're not interested in anything. We could be interested in this area or also this area. Okay, now keep in mind that earlier when we were here, my premium and discount was of course different. Initially it was like this, then we just continued to the downside, we never retraced, and therefore you need to adapt it until we actually change direction, come back up to our areas. But I was not interested in selling from here. That being said, if you have any question or request for me to cover something else about premium and discount, you can ask me. Always keep in mind to try to use it together with the trend and not against it, as you will increase your possibilities of being accurate and of entering successful trades. But of course, if you are at an advanced level, you can start thinking about some counter trend trades with less risk. And of course, if you take 10 trades in a week, I don't expect that half are together with the trend and half are against it. If you go against it, there should be maximum 10 or 20% of your total trades. So the majority should be with the trend, okay? Thank you so much for watching this video. I'll see you in the next ones. So we've already seen, and also we already also covered during my live trading sessions, what is the 0.5 retracement for, how to use it together with our overall analysis. Just to repeat it very quickly, it is used to understand and see premium and discounted areas. We never want to sell if we're not at premium. We never want to buy if we're not at discount, and so on. But of course, as always, we need our overall analysis to understand what's going on and to actually find our entry areas. So for example, right here, just a quick example, we have this push to the downside, which is breaking structure. We draw our fibs. Here it is our premium area, so we want to sell from premium. Here we have our supply. We didn't reach it, but this was the first sell-off. Now I'm checking if we will come back here to mitigate this supply to continue to the downside, but we don't want to sell down here. We want to wait for premium, okay? So we already eliminate some possible losses by selling down here for any reason that could be. Now, what do we need after understanding this is, I'll put up some pictures. It's a little bit messy because I was drawing. I'm not good at drawing. I'm not good at writing. I mean, not good at handwriting, but I'll explain what's going on right here. So this is clearly a move to the downside, and there is the arrow. So move to the downside with retracement above the 0.5 fibs, so retracement to our premium area in order to continue to the downside and just continue with the downtrend, okay? Because we were in a downtrend already. This is why the arrow is to the downside. So push to the downside, retracement to premium, continuation to the downside.
Now, many times, and this happens to a lot of people, maybe this move is breaking a previous structure right here or something, and they will look for buys at a demand area, okay? Maybe you have rejection, maybe we also have confirmation with our lower time frames confirmation, but then you just hit the stop loss. Now, why? Because we need a rule when trading this. We need a rule in general with our trading plan. So the rule is that, oh wait, I didn't mention something. Okay, if you want to continue, this is like your preferred entry if we are a premium with supply and so on. There is also the option that you can go against the trend down here. Maybe if we reach a strong demand area, which was not mitigated, we reach it and we have a good confirmation. And this is why I put these two charts examples right here for good entry confirmation for buys, either this one or this one, which are slightly different. As you can see here, we just change direction, we break the blue side. Here, which is actually the one that I prefer the most, we consolidate, grab liquidity, and then change direction, which I like better. But anyway, both are good. So if all of these line up, we can go actually against the trend. And also we are at discount, so we could target premium, we could target this area, okay? What's the problem? That many people, after this happens, maybe you can get some buys from here, we go to the upside, you should enter sells from here, and we come back to target new lows, they try to enter buys at demand area where we have rejection, because maybe we will also have these rejections at these demand areas, but we will eventually hit a stop loss. I'm not saying every time, but the majority of the times. So what's the rule? The rule is that you can look for longs when we are at discount to target premium. So basically this right here, we are at discount to target premiums, to target premium prices. You can look for longs, but careful going against the trend. Of course, you need to practice this. It's not as easy as maybe this trade right here. But what's the rule? The rule is that after we reach premium, so after from down here, you had your opportunities, we go to premium and we reach it, and maybe you have your opportunities for sales, and we come back to discount, so we have this move to the downside to come back to discount, you cannot look for longs anymore, okay? Once premium is reached, you will not look for buys anymore once we come back to discount. Same thing vice versa, okay? So here we have a clear move to the upside, retracement to discount for continuation, okay? And here we can look for, maybe if we are at a supply area, higher time frame supply, and so on, we can look for sales to target discount, but we have to be careful going against the trend. Here is our confirmation pattern, one of the confirmation patterns that we could use, and we can enter some sales, okay? Here is the pattern that we like the most. These are not necessary, this is better with the trend at discount, maybe with confirmation, maybe at demand and so on, with the confirmation patterns that we have right here. But what's the rule? That after we come back to discount, so after this move to the upside happens, so we go to the upside, here we can look for sales, but after we reach discount and we come back to premium, we will not look for sales anymore, okay? So just to, okay, right here, perfect. So here we have this move to the downside, okay? We have this move to the downside, and let's see if there is, well, there is not, but let's say, just as an example, let's say that there is a strong demand from the left. Here we go on lower time frames. Let's see if we have confirmation. The confirmation that I will need is that we break the previous supply. Let's see what happens. Here we respect it. Is it working or not? Okay. Okay, here we break it, and this is what I want to talk about next, but well, actually later. Let's see if we can get some entries. No, we won't get some. I will not get any entry for me personally here. We could have had some risky entry on this break of structure, retracement to demand, but it's not really what I like to trade. But anyway, we stop loss just below it, but it's not really what I like to trade anyway. Okay, so here we had our possible buy opportunities that we couldn't catch in this case, but in other cases we probably can, and we are reaching premium. We actually already reached premium. Now, after this happens, after we reach premium, and maybe a lot of people will be like, oh, here we have a demand, here we have another demand, and so on and so on. They will maybe try to look for buys again to target these supply maybe. But after we reach premium and we come back to discount, we will not look for buys anymore. We look for buys down here. We don't look for buys anymore once we already achieved the objective of the market, which is to come back to a premium price if the direction is to the downside. Keep in mind, if the direction is to the downside, come back at premium price to give, for banks to mitigate their positions. What does it mean? You should look at my videos again if you're missing some concepts, which means that they are exiting their buys which are in loss, and they will enter more or just keep their sells who they created right here with these big pushes to the downside. So we come back at premium for this reason. And as I was saying, once we come back at premium, we will not look for buys anymore once we come back down here. Let's see. Okay, so for example, this one, which is the price that is coming back to discount, we will not look for buys here, we will not look for buys here, we will not look for buys here. Okay, this is very, very important. Well, let's finish this. Okay, perfect. Okay, and vice versa in an uptrend. Let's see if I have an uptrend example. Well, not on the 5 minutes, maybe. Do we? Yeah. Okay. So the direction is clearly to the upside. You can see break the structure to the upside, retracement, premium and discount actually to here, the whole move. Okay. So from up here, if there is like a strong supply from the left, which in this case there isn't, but I'm saying if there is, that is a good setup, we reach supply, then you can look for sales targeting discount. Once that's done, you go lower time frames, you start looking for your buy setups and so on and so on. Now, let's say that here you can finally catch your buys and go to the upside. Here, you will not look for sales, even if there is a supply or whatever, because the objective of the market was already achieved, which is push to the upside, retracement to discount. Actually, here happened already, but let's also say here, once we reach supply again, or once we come back a second time or a third time to premium, we'll not look for sales anymore. Okay, so it could have happened. Let's do the whole process. So here we have this push to the upside. Price comes back to discount. It does, even by 0.1 pip, but it does. So once we come back up here at this zone, I'm not looking for any sell anymore, because probably we are targeting new highs, which is what actually happens, new highs. Okay, new highs. Now this is the new move, but we already reached discount, so no sells. Okay, We are only looking for buys. Now, this doesn't mean that we will be bullish forever. Of course, there is going to be the time where we'll finally push to the downside and change structure and start having a downtrend. But until that happens, we are still good for buys here. The other concept I wanted to talk about is still about the premium and discount, but how you can use premium and discount inside premium and discounted areas. So basically, as we were saying here, this is the move to downside. Here we have premium and discount, but then what happens if we want to enter, for example, buys from down here? We go on lower time frames, and basically inside the overall, which is the major, which is just to understand the direction of the market and the major premium discounted area. If we look for buys down here, which are after breaking this area, we will do the same on a smaller scenario. So here we finally break it. This move finally breaks the supply. Okay, we put premium and discount in order to wait for retracement to discount in order to continue, which in this case doesn't happen, but in other cases it does happen. They will continue, and then vice versa. Actually, here. Now here, I don't have confirmation to enter my sales, but let's say because we didn't reach the key area, but let's say that we reach the key area, we have our consolidation, we reach key area and drop. Then for our sales, we have premium and discount to come back to premium and possibly look for sales with stops above it. Okay, so premium and discount inside the premium and discount, but this, the bigger one, is the overall one, just to understand if we are a premium and if we are a discount on the overall move, while these two, this and this, is just for the entry. After we have confirmation that we are changing direction, premium and discount to get our entry. Okay. And how do you get your entry? Well, that will be explained in the entry confirmation video, but basically is the patterns that I was showing in the pictures, plus some other patterns. But it's all about liquidity, so grabs of liquidity and change of structure and the battle between supply and demand, who's in control. So that's it for this lesson. And thank you for watching. So let's see some examples. All right. I don't know, let's pull up some random charts. So one example is, for example, the trade from yesterday on GBCHF. Where was it from, by the way? So yesterday was here, perfect. So what happens here? Here we have this major structure, okay, which is broken by this move, and it is a strong move, and that's perfect. We have our supply area, okay, and our supply area is where it is, at premium. So we're looking for price to come back. Well, it already came back to premium right here, but it didn't touch our entry. So let's just, for the premium and discounted area, let's just go back and talk about it. So here, let's say that I don't see any reason to go against the trend right here because it's pretty clear, but let's say someone is crazy, and just for the purpose of understanding premium and discount, let's talk about it. You see a change of character, change of direction, however you want to call it, from down here, because we are breaking previous supply, we're breaking previous structure, and so on. So what do? You use the fibs in the opposite way to look for an entry at discount, to target premium areas. Let's see how it plays out. We come. Here you can get your entry. I will get, if I was looking for buys, which I wouldn't, but I will look from here. But anyway, there is also the option to just use your fibs for entries. Okay, 0.62. But anyway, I wouldn't get this entry. I will miss it. Oh. Okay, and here we reach premium and we start pulling back. We didn't reach, keep in mind that we didn't reach our supply, so there is no entry opportunity so far, but we reached premium. Some people would, what would they do? They would extend the premium discount in this way, and they will look still for buys from discount to go higher. Okay, which maybe in this case holds too. I don't know, let's see. It doesn't from here. Maybe we mitigate this area and we hold this area and we come back up. But anyway, as a rule, after reaching the overall, the bigger premium area, in this case, because this is a direction to the downside, this is a downtrend. After reaching premium and coming back to discount, we're not looking for buys anymore. We could have looked for buys down here on the first opportunity because we didn't reach premium yet. We were targeting premium, but after achieving the objective of the market, which is to target premium to then continue in its direction, then we're not looking for buys at any of these demands anymore. Now, in this case, and in some other cases, it will hold, like here it does, come back to the upside and reach supply. Okay, we reach supply and we have our confirmation that trend is changing. Okay, trend is changing, and this is where we got our entry. How? After reaching supply. So after reaching key area at a premium, because the overall direction is to the downside, this was just a more aggressive entry, more risky against the trend to just target premium, which we didn't get. I didn't trade this, for example, but I was trading this. What do we do here? After reaching premium and supply, we had that push to the downside here. That push to the downside, showing us that we're changing direction. Again, this will be all explained in the entry confirmation video. Premium and discount, okay? We have this supply at premium, and so this is my entry with stop loss just above the area. Okay, and target, you know how the trade went. Targeting new lows, just to make it clear. Targeting new lows because we are in a downtrend. We reached premium to continue in downtrend, so we're targeting new lows. There is no reason for me to not target those lows. What happens? This is actually a trade. I don't know when people will watch this video. Maybe it's going to be in the future, of course, because it's in the course. This is a trade that I actually took and sent to VIP members. Here we just mitigate and then continue straight away. Could have had second short opportunity, premium discount, shorting at premium. Then what happened? Let's just cover it, since even if it is not related 100% to this lesson, we create trendline liquidity. So what happens when we have trendline liquidity? We usually grab it. What happens? Wait, actually, what happens? We do grab it here, okay? One sec. Okay, we do grab it. We finally grab this trendline liquidity and the liquidity of the previous size to just continue. This on the 1 minute or 3 minutes happens a lot on higher time frames. It happens, but not so quickly and not as much. What happens here again? This video is also on my YouTube. I was recording this trade live. Trendline liquidity. We grab it. I was like, okay, but where will we stop? And I was like, okay, let's just see where we will stop. Premium, so I don't care about anything down here. Probably at the supply. I was recording live again. If you want, just go and look at the YouTube video. And I was actually entered as very, very small trade from here to go to the downside. And that's what actually happens. And we create new lows. So premium discount. All right.
Now I hope that the Fibonacci part was really clear and helpful for you, and if you have any question, make sure that you comment here below. I will answer any question that you have, and I will do my best to answer every single person. Now we are about to move into the liquidity concepts. It will be an intro on liquidity concepts, and liquidity, to be honest, is the most important concept that you need to know in order to be a profitable trader. Not according to the general idea, but according to my strategy and to my research on these 9 years of trading, what I found the most important and useful thing to use on charts and to actually use for entries, to use for exits, to use for just understanding price in general is liquidity. So make sure that you really pay attention to this.
What's up everyone, welcome to this video. In this video, we will talk about liquidity and how liquidity works, where liquidity is. Now, keep in mind that I wanted to actually do this introduction because the videos that you will see here only for the liquidity part, only this video, is actually a video that is available on my YouTube. So in case, I just wanted to make it clear that what is here in this video, all other videos are only for students, and I teach my strategies only to my students. They're not just out there like that. But this video, which is an introduction to liquidity, is actually a YouTube video. There are actually 2 of my YouTube videos about liquidity put together, just to give you an introduction about liquidity, what it is, where it is. So it's actually concepts that they are out there, they are available for everyone, both from me and from other people. Now, the difference, and this is where it gets interesting, is that this is just the introduction. This is just what liquidity is and where it is. The main difference that this course will make is how we use these concepts, how we use liquidity to our advantage, where we look for liquidity, how we trade with liquidity, how we get the entries with liquidity, at what time of the day we look for liquidity, and so on and so on. I just decided to take my YouTube videos, which are out there for free, for this introduction, because it is just an introduction. And of course, for an introduction, you will not see like some crazy concepts that you've never seen. Maybe you know this stuff already, but it didn't make sense for me to create a new video about liquidity where I will say the same things that I said on my YouTube video. So I just took these 2 YouTube videos of mine and I put them together, and this is the introduction. Now be ready for the next videos where you will actually learn how to use these concepts to our advantage. Now keep in mind, just because of this, don't skip this video. You need this introduction to understand what is liquidity, where it is, where we look for liquidity. So don't skip it and watch it, please. You just need to watch it once and you will start understanding. Of course, I usually recommend to watch the videos more than once, because repetition is very good for your mind and for yourself and for understanding better the concepts. And every time you repeat something and you watch something, you understand a little bit more, some details. So yeah, enjoy this video and I'll see you on the next ones.
Now let's get started. Don't want to waste your time. Let's get started with understanding liquidity, understanding how the market is moving. So first of all, I am sure that you've seen in the chart something like this. So for example, we have support and resistance. Keep in mind that I'm not actually using support and resistance, but let's just make an example on how, retail traders are trading. I mean, we are all retail traders, but we try to follow, the movements of the banks and follow some of the concepts that the banks are using. So let's say, for example, we're going sideways, and you try to short right here. So you're trying to short, enter a sell right here, and the price just goes straight to the upside. And this is fine. You're starting to think that this is a breakout, and therefore you want to enter on the break and retest. Okay, you want to enter on the break and retest. You enter a buy right here, and then we just go straight to the downside, breaking all these lows and just go straight to the downside, and you get 2 losses, and you don't understand why you sold at resistance and you got a loss. Then you have a breakout, you're trading your break and retest strategy, you're entering right here, perfect entry according to your strategy maybe, and then you get another loss. And maybe you're not understanding why. Oh, well, other than this, you're not understanding why this is happening. Same thing is that maybe you have a trend line, you're trading only based on trend lines. There's nothing wrong with trend lines, that just need to be used in the correct way and together with the right, with other things. We cannot just use trend lines. So we're trading with the trend line, you're trying to enter a buy right here, and then you have this nice move to the downside. Therefore, first of all, you probably entered a buy from here and got a loss. Then maybe you had also, I don't know, Fibonacci confluence or whatever, and still got a loss from there. Then you understand that this is a breakout, you try to trade the break and retest, you enter a sell from here. Maybe also you see some sideways movements, some nice rejections with some, I don't know, pin bars, and then we just go straight to the upside. This is because the market is, creating liquidity below this trend line, and now above these levels, they are just, accumulating a lot of liquidity in order to grab this liquidity, because a lot of people need to lose money in order for other people to make money. So the banks need to make money, and they need a lot of retail traders to actually lose money. They know how the majority of traders are trading. They know where the majority of traders are looking to enter trades and where they're placing their stop losses, and therefore they grab they grab these orders and then they make their moves. And in fact, after this accumulation right here, where a lot of people are just entering sells, adding sells right here, entering sells all over this place, because they see, they see the confirmation that there is a break and retest and some pin bars, some rejections from this area. They enter sells, and then we just go straight to the upside, maybe with just one huge candle to the upside. This is because we accumulated a lot of liquidity right here. Above this level, there were many stop losses, stop loss right here. And with one move, maybe just one candle, we just moved straight to the upside, grabbing all of this liquidity. Okay, so where is liquidity lying? So usually we have to take, double bottoms, double tops, equal lows or whatever, and trend lines, and we can see pretty much where liquidity is lying. So above these highs and below these lows, there is probably liquidity right here and liquidity right here. And in order for the market to move, what we will see usually is actually a grab of liquidity in either one direction or the other before taking the real direction. Now, this is a concept that I teach a lot in my course, especially for entries. We look a lot for these things for entries. We have, a particular list of things which we need to look at in order to enter trades. But for now, we will just understand what the market is doing with liquidity, where the liquidity is lying, and some examples. So also right here, this was EuroCAD. We can see that EuroCAD, we have a nice support. I'm not using support, but I'm just telling you how the majority of people are actually trading. We have a nice support is established. Now with a huge move to the downside, we are grabbing the liquidity below this level. This doesn't mean that we are turning bearish, because this is not a break and retest for continuation to the downside. This is just a grab of liquidity. Right now we are accumulating, just going sideways, and we will see where we are headed next. Of course, therefore, below this level, right here, below this double bottom and support, there was liquidity which was grabbed. So keep in mind that the market, the banks and financial institutions need to grab liquidity before making any move. Now, if I zoom in, for example, another example from the top right here was that everyone maybe was entering sales here, was entering sales. We have the move to the downside. Finally, everyone moves stop loss at entry, or maybe their stop losses were just above this level, because when you enter a sell, you probably put your stop loss just above the previous highs. So they maybe got profit, and maybe they are right about the direction of the market. The market is actually bearish, and in fact, we continued bearish after. So I'm not saying that you're going to be wrong 100% of the times. I'm just saying that even if you're right, the market wants to stop you out before actually taking that direction. The market wants to grab the liquidity before making the real move. And in fact, what happened was that went to profit, whether you had your stop loss above the highs or at entry, because maybe you made the trade risk-free. What the market wants to do is come back, take the liquidity, whether it is at entry or at the stop losses above these levels, and then continue through downside with some huge movements. And as you can see, this is what happened. And liquidity was lying just above that level. Now let's cancel these things and let's move to some other pairs, see if we have some good examples. All right, so also every time you see a trend line, we have liquidity above the trend line level. We have this trend line, for example, I don't know, this trend line in the beginning, we grab liquidity, continue to the downside. Same thing, this trend line, grab liquidity, continue to the downside. Now we have this trend line, and this is the reason why I don't really use trend lines that much, but I use them in confluence with other things in order to understand the direction of the market. Because same thing right here, are you going to buy right here GBP CAD because we had a small breakout on, I don't know, the 15 minutes time frame? This is a breakout, a retest, whatever, for a continuation, or are you going to short because we are touching this trend line and maybe you think this is a fake out? I mean, there is, in this case, I'm just not looking at trend lines, so there is no real answer. You just gotta keep in mind that the market knows that we are entering sells, and therefore there is liquidity all above this previous highs, all above this highs, there is liquidity, above these highs, there is liquidity, and the market actually wants to come back to grab that liquidity. I mean, this doesn't mean that we will just go straight to the upside, but at the same time, not many traders can win. I mean, as you know, 90% of traders are losing money, and the reason why they're losing money is because the market doesn't want you to win. Therefore, you will grab liquidity, will actually stop you out before moving in that direction. Let's see, I haven't prepared actually charts, so I'm showing you everything, real time with some good examples. Now, same thing right here. Support established. Everyone knows that this is support. Market is coming back to this area, and everyone might enter buys right here because I'm sure that you've seen these things 100 times. Support is established. We are expecting support. Finally, here everyone is entering buys, and I'm sure that everyone is entering buys because they see another touch of support. I mean, maybe not everyone, but a lot of people. And eventually what the market wants to do is push to the downside, grab the liquidity up below these previous lows. This doesn't mean that we will just go straight to the upside. Maybe we have some more liquidity to grab. Maybe below these lows, there is some more liquidity right here. Oh, sorry. Then let's see if we use a trend line, for example. I'm not even making examples with trend lines because I'm not using it that much. Perfect. So also below the trend line, okay, so even better. Everyone was entering buys, they see support, they see the trend line, everyone entering buys, everyone entering buys, a lot of accumulation, just sideways movement, and then just to accumulate many positions, everyone is entering right here, right here, right here. Many positions, stop loss below the trend line, below the support, and then eventually what happens is that we grab the liquidity through the downside. So make sure that you are always playing it safe, always managing your risk, and most importantly, understanding where there is liquidity. Because if the position is looking too good, probably it is looking too good to be true. Probably there's going to be a problem. Probably it will go to stop loss. When it is just looking perfect, that you have your support area which was tested many times, therefore you think that it will hold again, corresponds to the trend line. Maybe you're also using some Fibonacci's. Then we come to that area, start accumulating, start going sideways, just for the market to have some other people joining in entering this trade. So maybe also we are making some nice pin bars, some nice rejection candles, in order to make the people think that we will go up, and then eventually what will happen is that just with one huge candle we're going to the downside. Okay, and I'm sure that if you go on the charts right now and you start looking at these things, you will recognize how many times this is happening. Let's go to some other charts just to make some other examples. Now your question could be, okay, but now how am I going to understand the direction of the market if there are so many fake outs, so many grab of liquidities? This is where understanding the structure of the market and the overall direction comes in, and it is actually the first step that you should take when you're trying to follow the direction of the market. If you don't have a clear understanding of which way you want to follow, if you want to be bearish or bullish on USD CAD, you will not actually succeed, right? I'm just looking for some good examples to show you. All right, no, actually. GPUSD, no. Oh, perfect, this one. All right, GP, GPY. So we can see that, okay, direction is bullish. We want to follow this bullish direction, but even if you're right, maybe we will grab the liquidity and stop you out before continuing. Maybe we use our Fibonacci's, we're waiting for the Fibonacci retracement and everything. We want to enter right here. We see this support being established. Maybe we don't enter right away. Maybe we wait, go on lower time frames, go on the 1 hour, and we clearly see that we have a rejection, second rejection, third rejection, accumulating, a lot, just going sideways. And then eventually what happened was that below this support, we had a first liquidity grab. So stopping you out before actually continuing to the upside. And this is where, even if you're right, you're being stopped out, hitting your stop loss, and then actually going up. How many times you were right, but before going into your desired direction, the market actually stopped you out? I believe many times. So liquidity grab, continuation to the upside. Same thing, what happened after that was another liquidity grab below all these lows. So if we go on the 4 hours, you can see it even better. So we had the support right there. Everyone enters again at support. Also, if you want me to replay this thing, you will see even better. We come again to support and we make this 4 hours pin bar. What do you think that most of the traders are doing? They're entering buys right after this pin bar, stop loss below the support, take profit, and then eventually we are going to stop loss, grabbing liquidity, grabbing the orders, and finally continuing to the upside. So And guess what people are doing? First, entering buys right here after the pin bar. Then they're seeing a breakout to the downside of the support. Therefore, stop loss hit right here. The support is broken. Therefore, they're entering break and retest sells, okay? And then we just continue to the upside. So they're losing money both ways because the market knows how majority of traders are, thinking, reasoning. So I hope that you are starting to understand where liquidity is lying, where there is liquidity. For example, here was just below the support, and that you will pay more attention to, the movements of the market and where it wants to stop you out. Now, for me, for example, I use a lot of liquidity concepts for my entries in order to get accurate entries. If you want to learn more, as I said already, you can grab my course. There is a link here in the description below. I hope you like this video. I'll see you on the next one, and I'll just wait for you if you want to join us. What's up, everyone? I'm Edward. Today we will talk about the best trendline strategy. So now, if you know me already, you know that I don't use trend lines, and many times on my stories, my Instagram stories, I say that I don't use trend lines. But at the same time, on my pictures of my charts, on my screenshots, you see some trend lines. So you get confused. You don't really know what's going on. You don't know if I'm lying or something. Now it is time to tell the truth. It is time to talk about trend lines and how they work. Now, the reason why you may see that I use some trend lines sometimes is not because I actually look at the market based on trend lines, but it can be helpful as a confirmation. And this is what we will talk about today. And I will show you the difference between, trading based on trend lines and using them just as a confluence. Because many people think that the market moves based on trend lines. And let me tell you, this is not the case. Another thing that I wanted to say is that I don't have any problem, with the people on Instagram or whatever that are using trend lines. If it works for them, then great. If it works, probably means that they built a system around them that is, giving a lot of confirmations and that is actually providing them, good setups. This doesn't mean, again, that the market moves based on trend lines. Now, let's get started. Let's see what I mean. All right. Okay, perfect. Let's get started. GBUSD 4 hours time frame. A lot of people will start analyzing. They see this trend line right here, breakout of the trend line to the downside, and now this will be their opinion, break and retest, entering sells here. Now, maybe, and I'm saying again, maybe, we will actually go down from here. But at the same time, this is not just because we broke the trend line doesn't mean that we are actually bearish, okay? This is the whole concept that I'm trying to teach to all my students when we get started. This is one of the first concepts that is being covered just to, eradicate the overall mindset of, how the majority of the traders are thinking. Also because you got to think that, just think about it. If 90% of the traders are losing money and 90% of the traders are using these concepts, then it means that we need to use something different. Okay, so we have this trend line. It's broken through the downside. We have the break and retest. A lot of people are entering sells. Now, if you look at this from another point of view, this is just, we had the trend line liquidity right here below the trend line. And also we had a big accumulation right here. Let me put, okay. We had a big accumulation, and below all these lows, there was a lot of liquidity. Again, if you don't know what liquidity is, go and check my video about liquidity. There is also a video here about supply and demand, so go and check it out. If you want to learn more, if you want to learn how I trade, there's my course and there is the link here below. Now, as I was saying, there is liquidity below all these lows. These lows need to be manipulated, and here we have the manipulation to the downside and also the manipulation of the trend line. Now, this was a very good opportunity for buys at this demand area right here, which was fresh. At the same time, once these buys are completed, we need to remove this trend line, not trade based on just the trend line just because it was broken. And I will tell you in a minute how we can actually use trend lines in a good way that can be helpful. Now, just to understand what's going on right now, we have the 4 hours rejecting demand. We have also the 4 hours supply right here. And overall, we don't know yet if we're bullish or bearish. Yes, we gotta say that these lows were violated to the downside, might be just because of manipulation or might be actually a break of structure. Therefore, if these are a real break of structure, yes, we might be bearish. We will wait for the supply area to be reached to continue to the downside. And again, this doesn't correspond to the trend line break and retest. It is totally a different area. Okay, it's up here. A lot of people, by the time we are here, a lot of people will think that this is a fake out, and therefore, break and retest traders will get stopped out because we get to here. All of the people will start thinking that this is a fake out, they enter buys, and then we might go to the downside. So this is where the majority are getting trapped. With that being said, let me show you some examples on where it can be helpful. I don't know if in the past we can see some examples. All right, just here we can see some good examples actually. So first of all, we could see that we were clearly bearish right here, right? Lower lows, lower highs, lower lows, lower highs. If we want, we can put the trend line, okay? And with the trend line, we have a better understanding. Well, not actually a better understanding. We can see just the confluence with the trend line. So we have the trend line, which is a downtrend, and lower lows, lower highs, lower lows, lower highs. Therefore, we understand that we are in a downtrend. Now, we are in a downtrend, but here, all of the people will start trading, break and retest. Also, if you zoom in, you can see that on the retest, we had, a doji candle, a bullish rejection. All the people are entering buys and buys and buys, and then big candle to the downside. And this is because we built liquidity by creating this move. Basically, the smart money is building liquidity. They're making you think that this is a break and retest and then continue to the downside. The reason why this didn't work is because this was just a manipulation of the trend line, and it didn't break any of the previous important highs. It broke this high, but in this case, we will need to talk about the fractal nature of the market. You might get confused. It needs to, I will need more time to actually explain it much better. But basically, what I mean is that we need to look at the major trend. Major trend is lower lows, lower highs, lower lows, and here it is another lower high compared to this previous high. So unless we break above this previous high right here, then we are still bearish, okay? Now, we create an equal low right here, equal to the previous one, and keep in mind that when there are equal lows, there is always liquidity below it. And other than that, also equal low doesn't mean that we're turning bullish. If it is equal, nothing is changing. We go to the upside, and with this move, we are breaking the previous high, which is this one now. This was the previous high, and also the other high. Now, even if we didn't break above this one and only above this one, it is still a good confirmation for me that we're turning bullish. Here, we didn't have any confirmation that we were turning bullish. And this is where a lot of traders, are losing money just because they see, the trend line being broken, they think that we're bullish. And this is not really how the market moves, okay? Market moves based on, I don't know, I don't remember in English because I'm Italian, sorry. Market moves based on order flow and main direction. Sorry if I didn't remember. Anyway, went to the upside, broke the previous highs. Here, the order flow is changing the orders of the banks or whatever. I hate to say it. I really hate to say this because, you know, a lot of people are starting to think that they're trading like the banks or that they are institutional traders. We are using smart money concepts. We are using some smart money concepts, but you're not trading like the banks. Nobody is trading like the banks other than the banks. Nobody is an institutional trader unless you are an institutional trader trading for a bank, okay? You are trying to understand what the bank, what the institutional trader, or what the institutions are doing, and then you try to follow them, which is a huge difference, okay? Now, and this is why also you're not involved in this move to the upside, because you cannot predict that the banks or the financial institutions are going to change the flow of the market or whatever. You cannot predict it. Once it happens, once you see that the previous highs are being broken and the structure of the market is changing, not the trend line, the structure of the market is changing, therefore you understand that we're bullish and you can proceed to find your demand area to follow this direction and so on, okay? So this is the main difference, you know, between trading trend lines and market structure with some smart money concepts. Now, why am I using trend lines then on some of my charts? Because sometimes I want to, you know, point out the direction of the market. So let's say, for example, last week we were right here on GBP USD, and I want to point out the direction of the market, and therefore I will put the trend line right here. Okay, and I can see that I have higher highs, higher lows, higher highs, higher lows, and I have the trend line. So I keep in mind that we are both above the trend line and we're still bullish, and most importantly, the market structure is still bullish. So with these two things, I keep in mind that we're basically bullish, which is the first thing that I look at when trading, because I try to always go with the direction of the market, okay? Now, when are we looking for sells? Because on all of these moves, we were looking for buys. When are we looking for sells? We're looking for sells. Well, sometimes if we go against the trend, but it is almost never, like very rarely in few cases. But other than that, if we are going with the trend, we will need to see a break to the downside of the structure and of the trend line. So you see a breakout of the trend line, but it is not enough. Most importantly, you see a break of the structure. These, let me delete actually these two lines right here. All right. This is the previous low. You want to see a new lower low compared to the previous low. After that lower low, we will expect a new lower high. Not right here. We're not trading break and retest of support and resistance. We're not going to trade this support acting as a resistance. We are not, okay? If you want to, you can do. We are not trading that support as a resistance. We will find our key zones right here, our supply area, which, you know, needs to have a lot of more confirmations. And with that, we will expect a new lower high to continue to the downside and eventually create a new lower low, and so on and so on. Now, at all of these areas, this is the first step. I just wanted to say this is the first step, understanding the direction, understanding the trend lines, why you should use trend lines in some cases, and when you shouldn't pay attention to trend lines and you should pay attention to market structure. Now, other things that we should mention is that are, for example, that now, just because you know this stuff doesn't mean that you can trade just using market structure. You are starting from market structure with trend lines to understand where we're going. After you understand where we're going, you need to find some entry points. Those entry points even if they are supply and demand and you're not using support and resistance and whatever, even if they are supply and demand, just because there is a supply, just because there is a demand is not enough to trade. Those supply and demand areas have some criteria to be selected. Then at those supply and demand areas, for which confirmations are we looking for, and so on and so on. This is how you build a trading plan. This is how you build a strategy. And then you need to backtest that strategy and just be consistent, sticking to that strategy, not breaking your rules, and so on and so on. If you want to be a trader, you need to be willing to do this. Okay, a lot of people just think that they can just, I don't know, backtest once per month and it can be profitable. This is not the case. Okay, it is hard. You can do it. A lot of my students are doing it. They worked very hard to get here. They worked very hard to pass the FTMO challenge. They worked very hard to. Now that you know something about liquidity and we got started with some liquidity concepts, I got a news for you. I got something free for you, something extra for free. I'm giving away so many things for free in this, whether it is with GoFund Trader discount, whether it is with 1 month for free on MTJ. But right now I have a PDF ready with some liquidity examples, and you can just find it here below in the description. And it's completely for free. You can just download it, and there are some pretty good examples that I put together in the past, so make sure to check it out. Now we're putting things together. We're starting to understand the 0.5 Fibonacci levels. We're starting to understand what is liquidity and how it works, especially if you downloaded the guide that I recommend you to download. But what is next? One thing that I really found interesting is that your strategy can be a really good strategy, but it can be a really good strategy maybe during only New York session, or maybe only during London session. And if you don't know what these are, it's pretty simple. You can find it online. Just Google Forex trading sessions. It's different times of the day during which you can trade, and of course you can trade during all of them. The thing is just that your strategy might work the best during only few times of the day, maybe only during few hours. And you need to know this, but don't worry, because I will tell you right away this strategy during which hours it works the best. So let's move forward and talk about the best times of the day to use this strategy. What's up? Welcome to this video. In this video, we'll talk about the best times to trade and how we can see manipulation during certain times of the day and how we can use it to our advantage. Also, this video is for a better understanding of the market. Of course, as always, you will need your overall analysis with market structure, supply and demand zones, liquidity, and so on in order to actually trade and apply these concepts. Now, the times of the day that I will talk about in this video will be made more about the London and New York session, but keep in mind that you can trade at any time of the day. Of course, there are many students from all over the world, and you can trade also during Asian session. If you do trade during Asian session, just move to different pairs. Maybe move to Euro JPY, CAD JPY, AUD JPY, okay? Even GP JPY is good. Let's see. Also, it could be NZD JPY, very good also. So make sure if you're trading during the Asian session, you move to those pairs that maybe are moving more. Now, these concepts that I will talk about today for the London and the New York session will be applied more to the major pairs. So Euro USD, AUD USD, JP USD, we can say also JP AUD, GP CHF, Euro CAD 2 is fine, GP CAD, Euro AUD, yes, all of this. USD CAD 2 if we want, NZD USD, okay. But for the remaining, you either backtest for the remaining or this concept just apply less to the other pairs. Now, also these concepts will be applied with the Asian range, but we will do a separate video with that. Just keep in mind that before the London session, we have Asian, so there is the Asian range on these pairs. Now,
what we want to see is that usually, of course, not 100% of the times, because if it was 100% of the times, everyone will make money, but we have a high chance of this happening. This usually happens. So during the London session, we usually have a manipulation of the Asian range. In this case, it is to the upside. We can also have the opposite example with the manipulation to the downside and then rally, okay? So manipulation during London after the Asian range. I put just a different manipulation during London after manipulation, which is of course in the opposite direction of where the market wants to go. So manipulation to then drop to fake out all the players of the market, all the retail traders, all the people that are involved into one direction, all the people that are trading breakouts of ranges, all the people that are in a sell and have stop loss above the range. So manipulation, drop. And then during New York session, I put these boxes because this marks the London session and the second one marks the New York session. We can have a pullback, so New York pullback, possibly, as always, keep in mind, do it at a premium in this case and discount vice versa to then continue with the direction that we took during London after the manipulation, or vice versa, Asian range, London manipulation, we take a direction, and of course you can get trades during this move to the downside. Same here, you can get trades during this move to the downside. You can get smaller trades on the pullback, even if I don't recommend that at all. And you can get involved once more after the pullback to continue to the downside. Now, here, London manipulation, you can get involved into these trades to the downside. And then here, second box, New York reversal. Okay, so these are the two options. Of course, this is one scenario, and we have the opposite scenario, which is basically the same. So for buys with the London manipulation and take off direction, New York pullback to continue, and vice versa, just the opposite side for this. Now, how can you see this? We can mark our zones by using this indicator ICT kill zone. Then you go here. If you want to copy, this is what I have. Of course, I took off some things. There we go. Okay. So what we care about is not the whole London session, not the whole New York session, but especially these hours. Because during these hours, we usually see what we are interested in, which is the manipulation and is a possible take of direction. So, for example, not for example, but these hours go, and this is, let's see what, okay, London time, you can put yours, but refer to London time if you want to understand this video. It goes, London kill zone goes from 6 a.m., so 6 in the morning, to 9, actually almost 10. I usually do until 9, but just my preference, almost 10 a.m. So from 6 to 10 is your London kill zone. Then you have this space in between the London and New York kill zone. I don't really want to trade during these hours. I usually just get ready and do my analysis during these hours, which is actually just 1 hour, should be from 10 to 12, actually 2 hours. So I usually get ready during 1 hour before New York. So I connect at about 11. I start looking at the market. I see how we move during London. If I didn't trade London, because if you trade London, I already know what's going on. I already did my analysis. If I didn't trade during London, I connect 1 hour before my New York kill zone. I start looking at the market. I start analyzing. I start seeing what's going on. And then New York starts at 12 and finishes at 3 almost. Okay. And this is the second window where we are interested. Now, as we were saying, what do we see during these hours? We see the London manipulation here, to the upside before taking a direction. So strong move to the upside before taking the direction. And then during New York, we just have some small pullbacks. So this pullback to supply, another small pullback, couldn't really get involved here. And by the time we are down here, it's already done. The New York T zone is already over. Now there is also this little window. And what is this? This window is for the London close, okay? Why do we care about the London close? Because there is a chance, again, there is a chance that during the London close, we will have a pullback compared to the direction that we had during the day. And as you can see, during the day, we had a bearish direction, and during the London close, we have a slight pullback. Should be between 15 and 20 pips usually, but of course it's not a rule. And yes, it is 16 pips, okay? So you can get involved in all of these. Of course, the best one that we usually care about is going with the direction. So for example, break structure to the downside, okay? Retracement to supply, we have London manipulation, and then we take a direction, and we are interested in getting involved here. Now you keep the London closed just for a better understanding of the market, and it's not like that when this starts and you see that we were bearish the whole day, you just enter buys. That doesn't work. This is not something that, you know, it's not a rule, it's not something that happens every day. It's not like that. You need extra confirmation to actually do this. But I personally almost never trade the London close. I just prefer London and New York kill zones with the manipulation and possibly the pullback during New York, like right here, right at New York start, we have pullback, or the reversal during New York. Let's see other days. So this was just a consolidation day. Here during London, we had some manipulation. So the direction is to the upside. We had some manipulation to the downside to continue. And then during New York, in this case, we have New York manipulation to the upside, strong move to then reverse and continue to the downside. So in this case, let's see at our overall analysis, just to give you a better understanding. Where is the direction? The direction is to the downside, break structure to the downside, the market is bearish. Are we interested in getting involved during the London manipulation to continue to the upside? I mean, you can trade the market, go for buys, for sells. You can trade the market with, you know, against the trend, with the trend, as long as you have an understanding of it. But, and of course, also you will have confirmation to, actually go for buys with the during London right here, because we were at discount, and usually when we are at discount we target premium, okay? So you could have entered buys to target premium, but again, this is not the best option. Which is the best option? The direction is to the downside, break the structure to the downside, retracement. During London we are down here, New York makes the high, okay, and we are at premium, okay? So, and then we continue to the downside. So overall analysis together with this understanding of the market. Now, right here, another day, we have perfect example of what we were talking about earlier. But this is the Asian range, London manipulation. I'll just show you the Asian range, but I will do that on another video. Asian range, okay? London manipulation of the Asian range, straight to the downside, straight move to the downside. New York pullback to then continue, okay? So two possibilities here. What about here? Previous day, London manipulation. We just started ranging. What happens here? We don't really have confirmation for anything. We don't really break the previous demand, so it's not really confirmation for anything. But anyway, during New York, we have the pullback to the previous supply. During New York, we have another manipulation. So usually during these hours, we see the manipulation basically. During London and New York kill zones, we see manipulation usually, and to continue to the downside, okay? What's happening here? London manipulation to take the direction, New York pullback to continue with the direction. Keep in mind that there are also cases where we have as I showed in the beginning, where we have London manipulation for then having a New York just change of direction. It's not always a London manipulation, take off direction, and then with a New York pullback to continue. It's not always like that. New York can just reverse and continue in its own direction. Here, for example, we don't really have anything really interesting. Yes, we have this New York spike as always against, just a spike against the direction that the market wants to take, and we take out the previous high. So New York starts, we take out the previous high, New York manipulation, and then we continue, but it's not really an opportunity that I will look into. Same for here. Yes, we had a New York takeoff direction, but again, not really manipulation. But anyway, this, with an over understanding of the market and with knowing that during these hours you can have the most opportunities, and because you have manipulation, you have high volatility, usually the market takes a direction, this can really help you increase your accuracy and know during which times of the day you want to trade. Let's go back on EURUSD. Let's go way back just to see some examples. Okay, so perfect. Overall direction to the downside, we reach supply, right? What happens during London? During London, we have moved to the upside, and then we take a direction. We take a direction and break structure to the downside again. So what do we expect during New York? In this case, we understand that during New York, we're not expecting to change direction because the direction is still to the downside, confirmed by this move and break structure. Okay, so we expect a New York pullback. How do we trade the New York pullback? As always, premium and discount. We know that we don't care on getting involved down here. Here we have the order block, and we continue to the downside. You might argue, yes, we have this order block, but we have higher ones, and that's why you need lower time frames confirmation on possibly the 1 minute in this case, since it is a 15 minutes area. Or you enter here and you just put stop loss above the high. That's the other option. If you don't want to go to the 1 minute, just enter here and have your stop loss above the high, okay, which is 14 pips stop loss, not bad. You can book your 1 to 3, 1 to 4, even more, 1 to 5, but let's stay conservative. Or you go to the 1 minute, sorry if I repeat myself, or you go to the 1 minute and you actually look for confirmation, but we will talk about that in the confirmation video, in the entry types video. So what do we have here? London, little manipulation, not really a lot, but London moved to the upside before taking a direction. We take a direction and break previous low and break previous demand, okay? So what do we expect? We expect a New York pullback, which happens as always. We have premium and discount. We come back to premium, supply, and we continue. Okay. Of course, it looks easy now. It's not this easy, but this just gives you a better understanding of the market. Here we're just ranging. We do have a London manipulation to the upside to then take a direction to the downside. A New York pullback to actually retest this order block and then continue pushing to the downside. But then that's it. Maybe there were news. This looks like a liquidity spike with news. But anyway, you see that this holds. Is not the best scenario because, of course, we're not trending and we are ranging, but still. What do we have here? London manipulation to the upside. When I say manipulation, I just mean that we are creating a move in the opposite direction before actually taking the direction that the market wants to take. Okay, so what do we see in all these examples is, for example, a move to the upside before actually taking its real direction, which is to the downside. And then if we have confirmation that we are breaking structure, we're breaking previous demand areas, that we expect a New York pullback instead of a New York reversal, okay? And for example, here we pull back during New York open right here, perfect, and we continue, and then actually by this time we go break even, we don't break the previous low, and maybe we get taken out at break even, or if we don't move break even, then we just go to profit. I'm showing you all sales examples because this is what the market is giving, what the examples are giving me. Let's see if we have some examples for buys. Yes, so the market here is still bullish, examples for buys, all right? During London, we have strong move to the downside, manipulating the previous low and reaching demand, okay? So London manipulation in the opposite direction. This is what we want to see, opposite direction, strong move. And then we take a direction. You don't need to necessarily trade this if you're not sure, but you see break structure, retracement to demand, sorry. Either take the whole area, or even if you take the defined area, we still reach it. Continuation to the upside. What happens during New York, since we broke all the structure? New York retracement to then continue. New York retracement, let's see, yes, retracement to a discounted area. Here we have demand and we continue, okay? And then during London close, small retracement, but that's not really what we're interested in. We're interested in London open and New York, London kill zone, sorry, and New York kill zone. In order to trade the London manipulation, and then we take a direction. We don't really need to trade the manipulation. We can trade along the market after the manipulation happens and after we have confirmation. And then we want to trade New York if we have confirmation of, you know, what happened during London. If we have confirmation that we will continue that way. If we have confirmation that we are reversing, then we can trade the New York reversal, okay? For example, here, London manipulation to the upside, so strong move to the upside before taking a direction. The move to the upside has already taken out the previous highs, okay? So London manipulation of the equal highs, these are equal, okay? London manipulation, we take a direction, and then we have New York reversal down here at the end, yeah, almost half of New York, we start reversing and we have the reversal, all right? In this video, I'm just showing you the kill zones and how they work and how we really do have manipulation and how we can trade these at these times. But of course, I'm not showing you the whole thought process, which will be put all together at the end with, you know, supply and demand, market structure, lower time frames confirmation, liquidity, Asian range, and so on. But for example, let me just finish talking about this. Here we manipulate the equal highs. We are in a downtrend. We reach supply, and this could just be another beautiful trade. Okay. Anyway, I hope you like this video. As I said already, go through this video again and watch what and listen more to what I'm talking about. Listen more to what pairs you can apply this to. Look at the examples, look at how we behave during London, look at how we behave during New York, and also if you want how we behave during London close. Then go in your chart, put the indicator. As you know, I always say that I don't use indicators because we don't use indicators to trade. This just tells me the times of the day, basically. If I don't want to use this, I can do it without it. I just go on my chart and look at what time it is, basically. But this just helps you, it's just faster, you know. Anyway, go on your chart, put these, put my same settings. This is what you're interested in, and then backtest it. Go on the pairs that you like the most, see how they behave during these hours. For example, you like a lot GPAUD, go on GPAUD and check how we behave during London, how we behave during New York, and so on. If you want to trade during Asia session, then go to the JPY pairs, don't use these indicators and just look at how the market is behaving during Asian session. Okay, thank you so much for watching this video, and I'll see you on the next one.
I really hope that you're enjoying this video, and if you do, make sure to leave a comment, subscribe, do whatever you want, and let's move forward, because I have some other things to share with you which are extremely important in order to put all of these pieces together and really understand this strategy, which will allow you to really get results in the market. As I said already, the only way to really be good at it is to backtest and to know your statistics, know your accuracy, know your risk reward ratio, know your maximum risk reward ratio, know your drawdown, know all of these things, know your best days, your worst days, all of these things that are necessary. So for this reason, really check out MTG software. You're gonna have 1 month for free. There's no reason to not sign up. And of course, if after you don't want to pay, even if it is a small fee, even if you don't want to pay, don't pay, stop. But for 1 month, try it out, because it is crucial in order to get results. So let's move forward. With that being said, we are talking about the days of the week. Now, we're not just going to talk about Monday, Tuesday, Wednesday. We're going to talk about how the market moves usually during these days. You know, there is a theory that, or it's not a theory, you have a weekly candle and you can play with the weekly candle in order to understand the days, how they're moving. Now, if this is not clear, you will understand better once you see the video. But basically, we want to understand how the weekly candle is formed from the entry price of the weekly candle to the starting price. Let's say on Sunday night it opens, to the open price, to the swing high, the swing low, and the closure of the weekly candle. If we understand how the weekly candle is moving, we can actually profit during any day of the week. Now, usually I'm not really a fan of trading on Mondays, but you can still trade on Mondays. The strategy still works. It's just that I really like to be very selective. But let's see which are not the best trading days, but actually how the days perform and how they move. So let's move forward to the days of the week. Let's get this lesson started.
What's up, everyone? In this video, we will talk about the days of the week. This is for extra knowledge. It's not really something that you 100% need with our strategy, but it can add accuracy, just like the Asian range or the times of the day when to trade. This can add some accuracy and better understanding of the market, so you can actually try to look for these things. Keep in mind that there are weeks where I don't even look at this. There are other times when this actually is helpful for me, okay? So let's get started. So for the days of the week, the two things that I keep in mind the most is that there is a high chance. This doesn't mean that it will happen. It means that only there is a high chance, that on Tuesday, there we could form the high or low of the week. Okay, now I will show you what this means. And on Friday, if the week has been trending, let me actually maybe I misspelled chance. Anyway, Friday, if the week has been trending, we have a strong possibility of having a Friday pullback. Okay. Now, what does this mean? For this, we will need to use you need to go on charts. You can backtest previous weeks. You can take a look. Go on indicators and just put on your chart this indicator right here, week and day separator. Then you go to the options. You can take a look at mine in case anything is different from yours. Okay, just take a picture, take whatever you want. These are the colors, and this is all the same. So what does this mean? Okay, let's go on the charts. And let me actually delete this. You can take a picture of this and I'll delete it now. So
Okay, perfect. So let's put the indicator in the chart and let's go to the 15 minutes maybe, okay? So as you can see, this indicator will divide the weeks. So this is when the week was over on Friday. Friday week is over, then we start a new week. Here again is Friday, we start a new week, and so on, as you can see. Of course, I don't keep it on the chart when I'm trading. I just need it for some extra understanding of the days of the week. Now, as I said, there is a high chance that on Tuesday, we will either create the high or the low of the week. Now, what happened? Let's take a look, for example, at the last 2 weeks. What happened on Tuesday right here? We created the lowest point of the week during the week, and then we rallied. What happened on Tuesday here? We created the high of the week, and then we rallied to the downside almost the whole week until Friday. And then what happened on Friday? What did I write? Friday pullback, Friday reversal. Okay, so we already see the Friday reversal here. Now again, we found 2 weeks where for example, this happened perfectly and it played out perfectly. But keep in mind that, of course, it's not going to be like this every single week. For example, right here, we kind of had some Friday pullback, not as big as this one. This was just a crazy one. Some news came out. But as you can see also here, Tuesday, low of the week, we've been rallying to the upside the whole week, okay, right here. And then on Friday, we had Friday pullback to the downside, so against the trend, right? So pullback to the downside. So these are 2 weeks where the example is just perfect, really, really perfect. But keep in mind that it will not be like this every single week. This is just, we have a high chance of this happening, high possibility of this happening. For example, let's see here. Here we created on Tuesday the high of the week. I'll just put it with, I'm not putting the names for any reason, it's just put different colors. And then let's see on Friday. Friday, for example, we didn't have the Friday pullback, which is just nothing, okay? Previous week, Tuesday, nothing. For example, here this was not really respected, but on Friday we do have the Friday pullback, okay, against the trend. We've been rallying to the downside the whole week, and then Friday pullback before market closure to the upside, okay? And these are about, let me see how many, just to understand. These are about 78 pips, so you can of course get opportunities. Now, what will you need this for? To understand better the market, to understand that there is a high chance of this happening on Tuesday and on Friday. And keep in mind that if you use this together with our usual analysis, then you can actually increase your accuracy. Because let's look what happened here, for example. Push to the downside, break a structure, supply level, okay, and high of the week on Tuesday, and then continue to the downside, okay? So you can use this understanding with, let's delete this so I'll show you what happened over there. So this is, even without, even without looking at the days of the week, you can still catch this trade because of course there is a break of structure to the downside, there is imbalance right here, there is the order block here. We come back to the upside, maybe have lower time frames confirmation at this area at the higher time frame order block, and then we drop to the downside, creating new lows. And of course, you don't need the week or days separators to catch this trade. But for a better understanding of the market and to actually just have an extra confidence, it was Tuesday, and this could have been the high of the week. So we knew that we were in a downtrend. On Monday, we rallied to the upside. We were still bearish overall. The picture is bearish. Here, high of the week to continue to the downside, okay? Now, let's take a look at another pair. For example, here was just on Monday, it wasn't on Tuesday. As I say, this is not every single week. So, and here we didn't have the Friday pullback, but for example, here what happens, we have high of the week, which is the same level as Monday,
high of the week, continuation to the downside. Overall, we are in a downtrend, so we can, and we were at order block, okay? This overall, this is a whole 4 hours order block refined to here, that wasn't touched, but anyway, you get the point. If I show you the 4 hours, you get what I'm saying. 4 hours order block, okay? Market structure bearish to the downside. Most recent breaking structure to the downside, okay? Retracement, supply level. And you just go to combine this understanding with the days and weeks separator. Let me delete this for a second. And you have the high of the week created right here. Let's take a look at the previous week. Keep in mind that we're bearish. As I said already, this needs to be used with an over understanding of the market, with our usual analysis, with supply and demand, liquidity, market structure, and so on. But what happens here? High of the week, okay? High of the week, and overall we are bearish, and probably we were on a 1 hour order block or something. Let's look. I know it gets messy a little bit. Where is it? Here, yes, order block, okay? Overall, bearish, because we just broke structure to the downside here. Break structure to the downside, retrace, bearish. Let's see. At the premium area, perfect. High of the week. Continue. Friday pullback. Okay. Now, of course, trading, I'll just put this color just to differentiate. As you know, trading against the trend is never a great option. So Friday pullbacks are way more risky than Tuesday high of the week or low of the week, because right now I just showed you bearish examples, but if we are in an uptrend, okay, and we are going bullish, then you might catch the low of the week on Tuesday right here, or low of the week on the other Tuesday later. So it's the same for bullish or bearish examples. We just had bearish examples here. Now, of course, the Friday pullback will be a little bit more risky compared to trading the Tuesday low or high of the week, because you will be going against the trend and you need a good confirmation that we are reversing. So for example, let's look at that. Here we are completely bearish. Okay, we know it's Friday, so let's take the indicator off just to make it more clear. What happens? Supply fails and demand holds. Demand holds. Are we at a discounted area? Yes, we are. We just reach it. This is demand. We can buy just below once we enter the discounted area. Stop loss below this level, 16 pips stop loss, and you target and you use the Friday pullback. You possibly target a 1 hour order block. Let's go and check. There we go. Or you target, you can either target an order block, which is this one, okay? Or you put your premium and discount of the overall picture and you just target the premium area. But of course, risk to reward becomes a little bit more, well, it's still 1 to 3, about 1 to 3. Target premium because we are at discount, okay? And we target premium. Premium, even better, order block, okay? All right, I hope this is helpful for you. Is some extra understanding of the market, can be very helpful. Make sure to backtest it also on your own. I use it more with these pairs that you see here, and two with Euro AUD possibly. But if you want to use it for other pairs that you see down here, then you need to backtest it, because I mostly used for these up here. Thank you for being part of. Thank you for watching this video, and I'll see you on the next one.
Now we're really getting there. All the pieces are being put together, and I believe that right now maybe you don't have clear yet what we need to do, but the reason is that we need to actually put all of the pieces together. We cannot have a puzzle done in half. We need to put all the pieces together in order to really have a complete strategy and then understand how to use it. It will be pretty simple once this video is completed and once we will actually have the second part of the video. So with that being said, let's actually start talking about order blocks, supply and demand levels, what it is, how it works, and why it's really important to know. Now, just for you to understand, according to my strategy, liquidity levels are way more important than any other concept that we're going to talk about. But this doesn't mean that we're not going to learn about the others, because liquidity by itself doesn't work. None of these concepts by themselves work. It's the fact that we're putting them together in a profitable way, in a way that was tested. It's not really about the concept, because a lot of people know these concepts. Maybe not all of these concepts, but a good part of these concepts can be found. But it's how we're going to put them together in order to use them, during which hours, during which days, at which time, at which levels, and all of these things will literally make a difference in the results of the strategy. And most importantly, I'm giving you the tool to backtest it and to really know your statistics. So with all these things put together, you're gonna know how to be a profitable trader. So make sure to stick to the end and make sure to subscribe, because I'm gonna share some more sauce in the future. What's up, everyone? So today we are talking about different ways you can trade with supply and demand. See a lot of people talking about, order blocks and whatever. Supply and demand is order blocks. It is the same thing. So let's cover different ways you can use supply and demand. I will tell you my way, and you can choose if you want to use the same strategy, the same way I'm using, or if you want to just use it in a different way. The concept is the same. The way to use it is slightly different, but supply and demand works the same way. So let's get started. You saw already the supply and demand webinar, where I tell you how to identify good supply and demand areas, that they need to be fresh, and so on and so on. Now, as you know, I'm doing this on 4 hours and 1 hour, and I'm trading fresh areas. So for example, this supply area, this demand area, let's see right here, this demand area right here. And these are all fresh areas because they were never tested before. So this is the first step. Then what I do is that not always, of course, I don't always need to have the Fibonacci's, but if I do have Fibonacci confluence, then even better. It is an extra confluence for me to enter the trades. So for example, let's see right here if we have it or not. Right here, I don't think we have it, but this is a good supply area. Now, in other cases, we do have Fib confluence, where the supply or demand corresponds to our Fibonacci's, and that's even better for me. Now, this doesn't mean that you need to use Fibonacci's. I don't even use them 100% of the times. Like in this case, I would consider GP, JPY sells, even if we don't have Fibonacci confluence, all right? Now, another thing which I recommend you to do and will be very helpful is to mark out the 50% of the order block, the supply or demand area. And that could be, if you don't want to, if you don't want to use the 1 minute strategy and wait for Wyckoff and just go crazy on the 1 minute, you can just try to enter at the 50% of the order block of the supply or demand area. There are two ways to enter. One way is at the open, at the lowest side for supplies or the high side for demands, or you mark the 50%, of the areas, and you enter at the 50%. That's a very good way, and you can even split your two entries. You enter with half right here, half at the 50%. You enter, and as you said, stop loss above the supply or below the demand, and you're targeting next areas. So for example, these lows right here. Of course, you can target even lower, but if you're happy with a 1 to 5, you can trade it like this. Now, this is one way, 4 hours, 1 hour. In this case, we don't have Fibonacci confluence. When we do have Fibonacci confluence, it's even better for me. And this is without going in the 1 minute. Now, the next step is, if you want to, it is not necessary. I have a lot of people in the group, a lot of students just trading with supply and demand. Some are using also the Fibonacci's, some are not. I personally really like the Fibonacci's. If I do have Fibonacci confluence, it is even better for me. If I don't, there still could be a trade that we enter if it is a good setup. Now, as I was saying, 1 minute strategy and 1 minute entries. It is not necessary. A lot of people, a lot of students in the group are not using the 1 minute entries. They're just using supply and demand, Fibonacci levels, or just supply and demand. And we mark a structure, of course, that's the first step. And if you want to, if you have time, if your schedule, if your routine allows you to actually stay a lot in front of charts, then you can go on the 1 minute, start looking for possibly Wyckoff. So for example, we have when climax automatic rally secondary test, we have a spring, and then a continuation to the downside. All right, so you can start looking for this if you have time. This is not necessary. Of course, you could get better entries, but you will be a good trader already just by using the supply and demand strategy with the correct risk management. Sorry for all the noise. With the correct risk management and with Fibonacci's if you want to, and of course by following the trend, never going against the trend. At least the majority of the times you can of course try to catch some reversals, like in this case this will be some type of reversal. You could take your chance if you have a very good risk to reward ratio. If not, stick to following the trend. All right. Now another thing, and this is one way to use it, and I already gave you many options. I know it might get confusing, but the purpose of this course is to make you an independent trader, and there is no reason for me to give you only one way of trading my strategy, because of course there are many ways of trading my strategies. Those are the concepts, and then you need to choose what is working for you. So do you want to use the Fibonacci's? Yes, no. Do you want to use supply and demand by itself or with the fibs? It's up to you. Do you want to use the 50% of the demand or supply area? Well, I recommend you to. So this is not really a choice. Yes, you should use the 50%. Now, I'm trading 4 hours and 1 hour. What you can do is trading on the 5 or 15 minutes. So let's see. 5 and 15 minutes, you have, of course, sorry, supply right here. But of course, you can see if we are trading market structure, we see a break of market structure right here. This is a breakout of the previous structure right here, as you can see. Breakout to the upside, retracement. This retracement is retracing to this demand area. We mark the 50% of the demand area. Perfect. Let's put also the fibs if you want to. If you don't want to use them, that's fine. You don't need them. Let's put the fibs. In this case, we don't even have confluence with the fibs. We didn't really touch it. But anyway, and in this case, the fibs wouldn't be helpful. This is a good example when you can, avoid to use them. This is a trade that I will take. If I'm trading on the 15 minutes, I will take it. So you see a breakout structure, a retracement. Your retracement is to a demand area, and it is the only valid demand area of this push with the base and a big push to the upside. It was fresh. We're coming back, testing the 50% of that area, and you can enter targeting the next supply. So you enter at the 50%, stop loss just a bit below it, and take profit before the next supply area. 1 to 5 risk to reward ratio. So there you go. There are many ways. You can use lower time frames. You can use higher time frames. If you do use lower time frames, what I recommend you to do is maybe start analyzing on the 1 hour and then do your entries and start understanding the market structure on the 1 hour or 30 minutes, and then take your setups on the 50 minutes like this one. All right. Instead, if you want to do like me, I'm trading 4 hours and 1 hour with supply and demand, fibs, and everything you always see. Also, the 1 minute strategy, yes, the 1 minute entries, not always, but I do check the 1 minute once we reach our area. So this is all. Just wanted to do, a quick parenthesis. Seems like, sometimes people think that I'm teaching maybe only one way to trade instead of, thinking about the concepts and taking the concepts and applying them in the way you want to apply it. There is no one way to be a profitable trader. There are many ways. There are many ways to lose money. of course, there are many ways to be a profitable trader. Now, with these concepts, you can use them in different ways. You can use them the same way as me by looking at the videos, basically using my same strategy, or you can modify them a little bit, use them on different time frames, use them maybe with, I see a lot of people in the group, well, I don't use indicators, I'm not a fan of indicators, but some other people in the group maybe are using moving averages for confluence with the trades, and therefore if it works for them, you can use it. All right. um, this is all I wanted to say. I hope you liked it. I hope you understand my point. I hope that it makes more sense now that you're seeing, different examples on how to apply the strategies in different ways. And I'll see you on the next video. Right, welcome everybody. We are here today to talk about finally the 1 minute strategy, which I'm adding to the course right now. I didn't want to add it right away. Reason why is because I wanted to actually backtest the strategy a lot, test it on my personal account so I could see the results. I don't want to add strategies to my course if they're not working good, if I'm not comfortable with using them. I am personally using this strategy on my scalping account. So after some time of backtesting, about 2 months, I finally decided to add it because it is working very good, and it is right that I actually put it in the course so you can learn it. You can decide if you want to use it too. So first of all, it is called the 1 minute strategy because we take entries on the 1 minute. Now, keep in mind that we will not only look at the 1 minute in order to enter, we will do multiple time frames analysis. This is why it works really good. We start from higher time frames and then the entries are on the 1 minute. This is why it is called the 1 minute strategy, all right? Now, wait, let me actually, okay. Now, we need to look for specific things when looking at the 1 minute. And of course, I will explain all of them to you in this video. The 1 minute strategy, as I said, as I mentioned earlier already, it is working very good. It is giving good returns, but needs to be used in the correct way with low risk and in certain cases. The cases I will show you in a bit, in which cases we will use the 1 minute strategy. I mean, you can use them in all cases, but you need to look for specific things in order to get your entry. Now, you can actually, as I said, I'm using it on my scalping account, but you can actually use it for both scalping or also just to get your entries for intraday trading. You can decide. Now, keep in mind that, as I said already, we will not only look at the 1 minute time frame, because you cannot trade just looking at the 1 minute without looking at anything else. We start from higher time frames, and then based on that, we move down to the 1 minute, right? So let's get started. I had actually many examples, like 2 or 3 examples ready, but today the perfect setup took place. I wanted to show to you what we were looking for because this was perfect. So I want to do this example with you. This is a trade that we actually entered. And keep in mind that also for if you want to use the 1 minute strategy, another rule is that, well, I'll give you the rules right now. So the first rule is, as always, as all of my strategies, is to go with the trend, right? If you go against the trend, if you go against the market structure, then the 1 minute strategy will not work. Just like all my other strategies, if you don't go together with the trend, together with the market structure, together with the market, you will lose money because statistically, and at the end of the day, trading is about statistics. If you go against the trend, you have less chances of being profitable. So we will always want to go together with the trend, and this is the first rule. Second rule is to be very patient. Well, this is easy to say, a little bit harder to do. Third rule is to wait for the confirmation that I will actually give you, that I will show you later, and never get early entry points, okay? And the fourth rule is to use minimum 1 to 3 risk to reward ratio. I know that in other videos, in other strategies, the minimum that I say to use is 1 to 2 risk to reward ratio. In this case, for the 1 minute, I believe that it is worth it if you use minimum 1 to 3 risk reward ratio. I usually find like 1 to 4, 1 to 5, also about 1 to 6, 1 to 7, even more sometimes. But make sure that the minimum is 1 to 3 risk reward ratio. Right? So let's get started. We know that we want to start on the 4 hours, as always. We want to understand the market structure and the direction of the market. If you don't understand how to do that, go to my market structure video. I made a whole video about market structure, so you can actually master how to identify and understand the market structure and the direction of the market. So right here, we could see that we had a bearish market structure, lower lows and lower highs. Finally, down here, this is Euro New Zealand. Down here, we made a lower low compared to the previous low, a lower high compared to the previous high, and then everything started changing. We have this higher low compared to the previous low, right? Higher low compared to this one. We don't care about it yet. Right here, we have this higher high. Now, this is a trade that we actually entered, so I'm not making an example just to make an example. You know, this is a trade that we really took earlier. I don't know when you will watch this video, maybe maybe a long time from now, but still, this is a trade that we entered today, and I looked for the entry on the 1 minute. This is why I'm showing this to you. Just a perfect example, right? So as you saw, we had a bearish market structure. Finally, we started changing this bearish market structure from bearish all the way to the downside to bullish. And this is the reason why I started looking for buys. We made a higher low, we made a higher high, and then I understood, I said, okay, now I will wait for retracement to the downside in order to follow this bullish market structure. So in my opinion, we are not bearish anymore, we are bullish. Therefore, in my mind, I know that I need to start looking for only buys and stop looking for sells, right? This is like all the steps that your mind needs to do. After that, you start looking for a possible entry point. So first of all, you understand that we want to look for buys and not for sells anymore because the direction is probably to the upside. Now we need to understand, okay, but where do we enter in order to follow this bullish momentum? We need to find an entry point, all right? We need to find an entry point, and it is the same as always, same as you saw on other videos. So Fibonacci's, supply and demand, all right? So we have the Fibs, all right, as always, Fibonacci's, and this demand area, all right? If you don't know how to use supply and demand, go watch my supply and demand video. Now, this is just to focus on the 1 minute strategy. So we find this possible entry point. We know that we don't want to enter at the top of this demand. Reason why is because we don't have confidence. Remember, we always need to have confidence with something else. Just can't rely on only one thing. So we don't have confidence at the top of the demand area. We want to enter at the fib levels, right? So we understand, and we finally found our possible entry level. Now we can finally go to the 5 minutes and then 1 minute to start checking for entries. So first of all, we just need to be patient and wait for the price to reach our possible entry points, which will take some time, of course. You wait, goes down. Right, we are reaching the entry point. Now, remember, we're bullish on the 4 hours and we're trying to follow that direction. But where are we going on 5 minutes? Now that we are getting close to the entry point, we are actually going to the 1 minute, right? Where are we going on the 1 minute time frame? And this is why it is called the 1 minute strategy. Where are we going? We're going to the downside, all right? We know that we're bullish on the 4 hours, also on the 1 hour, of course. But on the 1 minute, we are bearish because we are retracing before having the push to the upside. I mean, we think that a push to the upside will happen, and we will see about that. So we keep going, keep waiting. All right, and we see that we hit the 62 fib level. This is, and you start doing the same thing as you did on the 4 hours, you start doing the same thing about market structure. So you actually look at the market structure on the 1 minute. So the high, the low, the lower high, lower low, lower high, lower low, lower high, and so on. So when we get right here, we have this previous high, right? And these are the previous highs. As you see, we come back to this previous high. We did not break it, so we cannot start looking for buys. And we continue to downside. So delete this one, keep going, keep going. We continue to the downside, creating new lower highs and lower lows. This is all in the 1 minute, keep in mind. And we reach the second fib level, which is inside the strong demand level of the 4 hours. We are reaching the 0.705 Fibonacci level. Keep going. We know that we are hitting a possible entry level. And right here, we can see that something is starting to change. So first of all, this was the previous high. Previous high, you had the retracement to that, was hit, continuation to the downside. And now we can start noticing some higher highs, higher lows, higher highs, higher lows, right on the 1 minute. Now, we will not enter right away just because we see that the 1 minute is aligning with the 4 hours. We're not entering right away. I mean, you can, but don't do it. We want more confirmation, all right? This is like very specific. So we keep going. We can see that we are breaking above all these highs, creating a nice uptrend, creating higher highs and higher lows, all right? Perfect. Even better, breaking these previous highs, all right? Which were even stronger. So right now, after we saw this, we are 100% bullish, okay? We are 100% bullish after breaking the market structure right here and also this one. This is all in the 1 minute. Continuation to the upside, crazy continuation, right? And we finally start seeing a retracement. Let's wait for this retracement. All right, all right. So keep in mind what happened right here, because we will come back to that later in a bit, all right? So start seeing the retracement. Let's check. Sometimes you need to go to the 5 and then go back to the 1 minute. You go back, check what is happening. Go back to the 1 minute. Okay. Perfect. All right. This is where you want to enter. Let me show you. So you saw this confirmation right here earlier. This trade could have been already taken, but we want to wait for something more. We want to wait for the actual move. And this is really a lot about understanding the psychology of the market. So as you know, the big banks, the financial institutions want to hit their stop loss before we start going to the upside. All right, this is the first thing that we need to understand when we are trading in general. Like before, this is why maybe sometimes we put stop loss to the entry and then the market just goes, comes back, hit your stop loss at entry, and then skyrockets to the upside, right? Because they want to hit your stop loss before they actually take off, right? Now, this that happened right here was already a confirmation that we could continue to the upside, right? You had the previous market structure. The market structure of the 1 minute was aligning with the market structure of the 4 hours. And this is what we're looking for, because maybe on the 4 hours you're going up, but on the 1 minute you're going down, and that doesn't correspond. You want the two to go together. So we're going to the downside on the 1 minute. We knew that on the 4 hours we were bullish. We were waiting for the 1 minute to align with the 4 hours. Right now, it was starting to align right here when we had the break of the previous structure. This was already a nice confirmation, break or retest for a nice continuation to the upside, all right? We didn't enter yet. Reason why is because we know that usually market makes a fake move, comes back to hit the stop losses or to to take off some stop losses, create some panic to the people that maybe some stop losses will be hit even lower, and then takes off. Right now, what we will look for is a possible manipulation before a strong push. So this type of coming back here is a possible manipulation. Also, right here we were establishing this support. Maybe a lot of people were entering right here, and then you get this manipulation to the downside before the price goes to the upside. Keep in mind that sometimes you need to check actually the 15 minutes or whatever before entering. Now maybe you missed this entry, and I will show you some other entries that you can take still on the 1 minute. This is all about starting from the 4 hours, checking lower time frames, and going all the way down to the 1 minute. Now, maybe you missed this change in market structure on the 1 minute or whatever, right? It is fine. Still, market structure changed right here the first time. If you remember, market structure also changed here after this push on the 1 minute changed, and you could catch the second move. Now, what do we want to see? Guess what? This was on the 15 minutes downtrend, lower highs and lower lows, lower highs and lower lows. This is still a lower high compared to the previous high. This is still an equal low. And then what happens? A higher high compared to the previous high. This high is being broken to the upside by this move, all right? We're turning bullish. Turning bullish, and we want to get an entry. Now, we want to get an entry, but we don't know where to enter, okay? We need to check. We continue to the downside. You can just see we skyrocket, all right? Let me go back actually. Skyrocket to the upside. We want to get a possible entry, maybe because we missed the opportunities all the way down here. That's fine. You can still find some other opportunities. You miss these opportunities all the way down here. You are on 15 minutes. And let's see. You go through 1 minute. Oh wait, let me actually. On 15 minutes, you start looking for, after this push to the upside, you start looking for possible support. This is the support that we have, all right? Support, demand, all right? This is the demand that if this held, if this is not broken, we continue to the upside, all right? We follow the bullish trend. Everything changed. Right here was broken. We were going to the upside. Okay, keep in mind that this is the perfect entry for the 1 minute. You just see that we hit the demand of the 4 hours. We hit the entry point of the FIBs. Market structure is changing because it didn't change right here, so that didn't make sense to enter. Market structure didn't change on the 1 minute. It changed all the way down here. And if you didn't get the first entry, you had the market structure that was changing also on the second entry. Change of market structure, you wait for the break of market structure, so it is changing from bearish to bullish. You wait for the retracement, which will be about 2 or 3 pips, and you enter. All right, now I will show you where to place stop loss and take profit, of course, and all of that stuff in a bit. Now, we were saying, all right, we are looking to follow this trend, and this is the trade that we actually took today. After all this bullish momentum, we found this key area, which if it was broken to the downside, we were going to stop loss. So we were turning maybe bearish again, but we went to the 1 minute and we saw that, we know that we're bullish, we're looking for buys, but we saw this downtrend on the 1 minute. So what we're looking for, as always, is a change of market structure. Right, and right here, it is the change of market structure. This is the previous high. This is a higher high. This is all in the 1 minute, and this is the retracement. Now, keep in mind, as I was saying, there is a concept called the spring. The spring is a fake move that the market makes in order to make the majority of traders think that we will go into a direction. That's why you see a lot of times a fake breakout and so on. So you will see probably a spring after this change. This is what we're looking for, and it is perfect because it is an extra confirmation. You will get like scared probably because you will think that you might not enter the position, but this is actually what we're looking for in order to enter our trade. It is even better. It is another confirmation. So right here you have the previous high. You go back, it's fine. Right here you have the higher high, and you know that we are waiting for the retracement in order to enter. But even better if there is a spring. So let me show you. You go down and perfect. This is the spring. This move right here is the move that makes you think that the previous low is being broken to the downside, all right? Even though the market structure changed right here from bearish, because this is the previous high, and we made a new higher high, and maybe you wanted to enter right here, you need to wait more. Just be patient. These are 1 minute candles, so it is not a problem to wait, and you will see this fake move. Of course, you don't enter all the way down here because maybe it is not a fake move. You just wait. You see this nice move to the downside, and then right after some candles going to the upside, all right? These are all the stop losses being taken out, and also this is about making most of the traders think that we will continue to the downside, all right? But we know that the market structure changed, and we know that this spring happens in order for us to think that way, all right? Still wait. And we can get our entry here, right? We still wait. We see this huge push to the upside. As you saw, it happened right after the spring. The reason why is because the market grabs liquidity right here, grabs liquidity, knows that it is hitting the stop loss of many traders. It also knows that the majority of traders are exiting the market. They're not staying in this buy anymore because they see this breakout to the downside. It is not a breakout, it is the spring. Of course, we cannot predict that. If you've been my student, if you're looking at this course, you know that we don't try to predict the market, we try to go with the market. So we just wait, we don't enter down here just because we think that it is a spring, but we still wait. You see this move to the upside. This is a new higher high, breaking above also the previous high, and finally we can get our entry. We can get our entry maybe on this small retracement with this candle, and stop loss. This is the old concept. Stop loss below the previous structure, right? So the previous low, stop loss below that. This is only 15 pips stop loss. Take profit, we need to check for a possible area of take profit on higher time frames. So possibly this area right here is a nice take profit area. You see this target right here, and it is about a 1 to almost 1 to 4 risk to reward ratio, right? Let's check what happens later. Right? So right now we are actually here, but it is already good. Right here we are about a 1 to 2 risk to reward ratio. Yeah, almost 1 to 2 risk to reward ratio. We are waiting for that 1 to 4. All right. So this is all about the 1 minute strategy. Okay. Of course, don't stay there looking at all the market structures after you enter, because you will feel the need to actually exit the market earlier because maybe you see this move right here or wherever, right? just make sure that you start on the 4 hours, you follow what is happening on the 4 hours, but you want to follow that by looking at the 1 minute. You know where your entry point is, you know that your entry point is at fib levels, at supply or demand level. You put your entry point there. When you're reaching your entry point, you start waiting for the 1 minute time frame to align with the 4 hours. The reason why is because maybe you have the 4 hours that looks like this, right? And it is coming back right now to your entry point, right? This is the retracement to your entry point. Maybe you want to enter from here, right? And now it's coming to the downside. What you want to do is that you need to understand that this move to the downside is a trend on lower time frames, so probably on the 1 minute, this is a downtrend actually. You need to understand that on the 4 hours, sorry if I repeat myself, but I want this to be clear. On the 4 hours, we're bullish, it is an uptrend, but of course, on lower time frames, since they are very small, maybe you only see a downtrend. Maybe this is all you see on the 1 minute. We're just going down and down and down for this retracement to happen, right? When we finally start reaching that area, we start waiting on the 1 minute for a change in market structure. I'm doing all the steps also theoretically to see what we're looking at. So let me delete actually this one. Wait. All right. So right now I'm doing the drawing of the 1 minute, right? On the left we have the 4 hours. Right now I'm drawing the 1 minute. The 1 minute is just going to the downside, and it is about to reach our entry level. Let's say our entry level is right here. This is the entry level, maybe the demand level, which corresponds to the fib levels, right? And we hit it. We hit it, and we make a new higher high, right? This is all we're looking for on the 1 minute. Downtrend, we know that on the 4 hours, this is the 4 hours, we are in an uptrend, but we are retracing in order for us to enter. On the 1 minute, of course, it is a downtrend. Lower time frames, this is a downtrend on the 1 minute. Downtrend on the 1 minute, right? Right here, finally, what happens is that this is the previous high, and we make a new higher high, right? And therefore, we understand that the market structure is changing. What will usually happen, not every time, but what will usually happen is that even after this happens, you will see some manipulation at this area, because this is a key area where a lot of people want to get in, and not everyone will be able to stay in, okay? What could happen is that even if you saw a higher high compared to the previous high, and therefore maybe you expect also a higher low, instead of seeing a higher low, you see something like this. All right, and this one right here is the spring, right? This is what we are calling the spring, right? Reason why is because it is like a spring that like gives the force to our trade, to our pair, to actually go to the upside. It is like something holding it back before it is exploding to the upside, all right? Because this one right here, it is a grab of liquidity before we continue to the upside. This is all about the psychology of the market, psychology of the people, because at the end of the day, the market is based on people's behavior, right? And based on that, the institutions know how to control that, how to actually play with these emotions of traders. And they know that if this move happens right here, all the people that were entering right here because they saw the high will either hit the stop loss or just get out of the trade. We know that this will happen, not every time, but sometimes it will happen. You see a higher high, you start waiting for the retracement, and you have two options, honestly. I also do it. You either enter right here, you can just enter about at the same demand area, inside the demand area, and you just leave a good stop loss size in order for the spring to have space if it happens. Or the second option is that you wait for the spring. If you wait for the spring, you have this possible entry. You wait for the spring to happen, then after the spring we make a new higher high compared to the previous high. Keep in mind that the spring already happened, so we're not looking for another spring, only one spring, all right? You never know what happens, but this is what we're looking for. We make a new higher high, which is this one, compared to the previous high. And perfect thing would be to wait for a small retracement to continue to the upside, all right? And this is where the second possible entry that we get. Keep in mind that we don't miss a lot of pips from here to here. Maybe it is a difference of 4 pips, 5 pips. This is not a big deal, okay? And we enter right here. Stop loss below the spring, right? Take profit at the next resistance or supply, and keep in mind minimum 1 to 3 risk to reward ratio, okay? If it doesn't have a 1 to 3 risk to reward ratio, you don't enter. So I know I'm saying to you a lot of things together. It is like very messy, I understand. The thought process is really easier once you start practicing the charts. For me, honestly, it took some time to adapt to doing this stuff. Like for example, in the beginning, I was doing the same of the 4 hours and I wasn't waiting for the spring, okay? And I finally understood that the spring was happening, and also the reason behind the spring and why it was happening. And also I saw the results after waiting for the spring to happen, and I finally understood that the spring was necessary for us to trade the 1 minute strategy. We usually don't wait for that on 4 hours or whatever. This is mostly for the 1 minute spring, okay? And therefore, in the beginning, I was saying it was hard to actually adapt trading with this strategy, with the 1 minute, with the spring, and so on. But take your time, practice it, start understanding the market structure of the 4 hours, market structure of the 1 minute. Understand that on the 1 minute, you will probably see some fake moves like this one. And this is what you're looking for. Maybe a nice breakout of the previous high for your entry. Instead of entering all the way down here, you wait for that, you wait for the retracement and in order to follow the direction to the upside, all right? So this is all we're looking for, basically. It is the same as always on the 4 hours, supply and demand, Fibonacci levels, market structure, direction of the market, and then you go on the 1 minute for your entry. On your entry, keep in mind that you only look for your entry, like this is another very important concept. You're not looking for your entry at an area which doesn't correspond to a supply or demand. You're not looking for an entry here. Like if the market structure changes here, you don't care, you're not entering. You enter only if the market structure changes after hitting a key area, okay? Market structure changed, and then you wait for the spring and you see which entry you want to get, right? I gave you the 2 options, either all the way down here, it is more risky, keep in mind it is more risky, but of course you have a better risk to reward, or you wait for the break of market structure, retracement again, and then maybe you get another entry here to the upside, all right? So this is all for the 1 minute strategy. Make sure to practice it on demo first. For me, I practice it on a small account, on $1,000 account first, in order to see the results. Of course, it was the first time for me using it. Used it for 2 months, and then I decided to teach it to you since it is working very good with consistency. All right, with that being said, hope you liked it, and I'll see you on the next videos. For any questions, just contact me on Telegram or Instagram. What's up, everyone? Welcome to the 1 minute strategy video. Sorry, let me move this one real quick. 1 minute strategy video, second part. So in this second part, we will go a little bit more into depth about every single move of the 1 minute strategy. I call it 1 minute strategy, but it is actually a schematic known as Wyckoff schematic. Now, the only difference is that we don't care about every single move. We care about understanding basically where we want to enter and where the market is grabbing liquidity. Now, in this video, we'll go over how the schematic is formed, where we could enter the different type of entries that we could have, but please make sure that you are always following the trend, always trading in an area of supply or demand for your entry. And this is only used for confirmation, where you can have crazy stop loss sizes like 5 pips, 10 pips, or 15 pips. So you can get very accurate entries by using these type of entries in 1 minute. Keep in mind that the schematic, you can basically find it on every time frame, but we care about it only in the 1 or 5 minutes to have the confirmation. On 1 minute, you can see it more clearly, of course. This is why we're calling it the 1 minute strategy. It is for our entries, but of course, it needs to start from the 4 hours. You need to find the direction of the market with the market structure, trend lines, and everything else. You need to find a good entry level with probably your supply and demand levels, which need to be fresh, Fibonacci levels, and so on. Now you come down to lower time frames and you want to look for confirmations at your area of interest. If there is no confirmation, there is no trade, right? So basically what happens usually is that we have, let me actually write it down, we have the selling climax, which is this one right here, and then we have the automatic rally, automatic reaction, whatever you want to call it, AR, right? Automatic rally or automatic reaction, right? Then we have the secondary test, ST, secondary test. And keep in mind that these 3 moves right here usually always happen. Now, I'm giving you how this schematic played off, but of course, some concepts, some movements are different from schematic to schematic, because of course the market is not 100% of the times the same, all right? So in this case, we have selling climax, automatic rally, secondary test right here, and then this move to the downside is the break of structure, because as you can see, we were in an uptrend, and here we start turning bearish. We have the break of structure, basically breakout of market structure, right? So thus break of structure, right? With this move to the downside, and we're turning bearish. Now, we're not interested in entering yet. I mean, if you want to trade on 4 hours and 1 hour without looking at the 1 minute, you can do it. You just enter right away from here. You have a bigger stop loss and so on. I'm giving you these information so you can have like 5 pips stop loss and have a 1 to 10, 1 to 20 risk to reward ratio, which is crazy, but it is very helpful. Now, after the break of structure, right here, this move to the upside, right here is the spring, what we call the spring, right? Where we are grabbing liquidity. Why is this one the spring? Because it comes higher than the previous highs. So basically here, a resistance was established with this double top, and therefore liquidity is above this double top. It is where most of the people have stop losses. Liquidity lies above this double top. Therefore, what the market wants to do is come back up, create the spring, grabbing liquidity, which is above this double top, and then start to push to the downside. Now, we're yet not interested in entering the market. I mean, I will give you more options, but the best option is waiting. And I will give you all the options later. Now you see we continue to the downside. We have the confirmation that this is the spring. We have another break of structure here. We were going to the upside again. Here we have a break of structure to the downside. And then in this case, which usually doesn't happen that often, but in this case, we have another test of the spring, which is almost equal. Sometimes we do have a secondary spring that takes out the first spring, and then we have the push to the downside or to the upside if we are trying to buy. Now, keep in mind that the secondary spring is not really common. Usually the schematic plays off like this. We have selling climax, automatic rally, secondary test, breakout structure, which maybe doesn't happen right away. Sometimes we just have selling climax, automatic rally, secondary test, and then right away the spring and after the breakout structure, all right? So the breakout structure is sometimes we have it before, sometimes we have it later. In this case, we had it before, even better because we have a confirmation. We're waiting for the spring. Here we have the spring, another breakout structure, and we could be interested in entering some sales already. And then we have the push back to the upside, which sometimes could be even higher than the spring, and continuation to the upside, to the downside. And you can see that the moves are very, very big, and we're just pushing to the downside for quite some time, as you can see. Now, where do we want to enter? All right, first of all, we are not interested in entering right away, right here, okay? This is not where we're interested in entering. The first option is entering after the break of structure, which is the first sign of weakness that the market is aligning with our higher time frames. As I said already, keep in mind that we want the lower time frames to align with the higher time frames. Therefore, if in the 4 hours we're bearish, but in the 1 minute right here going to the upside we are bullish. The 1 minute we are bullish. We want to wait for that 1 minute to start aligning with the 4 hours. So once the 1 minute is aligning with the 4 hours, we can actually trade the market, trade and enter a sell. Now, for now, we're still bullish. Here we have the break of structure, and we might be interested in entering already. You might be interested in entering after some type of retracement. Maybe you can use fibs. You can enter just after some type of retracement. Keep in mind that this is the 1 minute time frame. It doesn't really matter if you enter right here or right here. It's like 2 pips, 3 pips of difference. So let's say that we enter right here at this retracement. Now, keep in mind that if you're not waiting for the spring, you will have a bigger stop loss, and you need to be aware of that because there might be a spring. If you already recognize the pattern and you know that there's going to be a spring, you either wait, or if you want to enter earlier, which I don't really recommend, but if you want to, you need to have a bigger stop loss. Just give the market space to move in case the spring happens. Maybe even bigger in case we come to this level right here. And then, of course, a good risk-to-reward ratio going to the downside. So in this case, the stop loss is like 40 pips, while GBP/AUD moves a lot. So maybe in other pairs, it will be like 20, 25 pips just to give the market space. And then, of course, you need to find your target. This is the first option, of course, not the best one. Second option is waiting for the spring. Here, we do have the spring. After the spring, we are waiting for the breakout structure. So we have the spring, we're consolidating for a bit, after creating the spring, push to the downside, we are breaking the structure and also breaking the trend line. Perfect. What we do, we wait for retracement. We can either use fibs on this retracement to the upside. Let me see, fibs right here. See this retracement, we enter at our fib levels. Short position, let's say we don't get the perfect handle from 0.79, let's say right here. Stop loss just above the spring right here. 10 pips stop loss. Take profit. You can be happy with a 1 to 5, but let's say we actually want to find an area for take profit. Where is it? All right, here. Let's say we want to find an area for the take profit. Here we have a demand, and well, perfect. This could be take profit 1 to 5 risk reward ratio. All right. Of course, we reached it. We actually went to the downside. If we just keep it, this is like 1 to 17. All right. But other than that, we are happy with a 1 to 5. We don't want to really wait forever for this trade to play out, and therefore 1 to 5, 1 to 7, 1 to 10 is good. In some cases, you're going to be able to catch some 1 to 20, of course, it's possible. Like in this case, if you just move stop loss to break even and just wait, then you will be fine. Now let's go back here, because of course we didn't cover the secondary spring that happened. I need to find where. All right. Now, as you can see, we are coming back for a secondary spring. As I said already, this is not that common. So what I recommend as the best entry in general is this one. Keep in mind that this was really perfect. We just stopped at the fib levels. Sometimes we come a little bit higher. So therefore, your stop loss needs to be above the spring. Make sure this is the spring. Make sure it is above it. So you're safe. At least the manipulation happened already. So it shouldn't happen again unless we have a secondary spring. But as I said already, it is not that common. Therefore, give the market the correct space just in case it wants to, create an equal high right here, but you should be fine because we grabbed liquidity already from this double top right here, which is selling time X automatic rally secondary test breakout structure. We are grabbing liquidity above it already. After grabbing the liquidity, we wait for the change of structure again, breakout of the trend line. This is the retracement. This is the test of the spring, retest or test of the spring, whatever, and then just move to the downside. Now, here we have the secondary spring, as you can see. This doesn't happen so often, so we're not really that interested in this one. In case it happens and you missed this trade already, you will need to do the same thing. Or let's say that you move stop loss at entry and we come back, we hit the entry, you need to do the same thing. Since you're not sure if this will be just a continuation to the upside, because of course the market is uptrending right here and it might just continue, right? It might just be a breakout and a continuation to the upside. Since we don't know about that, we draw the trend line, we wait for the change of market structure. Well, right here we are breaking the trend line. Let me zoom in to show you. Right here we're breaking the trend line, but as you remember, we need to use it together with market structure, and market structure is broken here. After market structure is broken, we wait for some type of retracement. As you can see, little retracement, and then we just go straight to the downside. So this could have been another very good entry right here from this level. Stop loss, as always, above the spring. That's right here, 13 pips stop loss. And let's say even if you want to put your take profit to here, which is the main level, this is already 1 to 2. And of course, I recommend to use a little bit more. And if we use the same area right here, it is almost a 1 to 4. But as you can see, you can get a lot more using this type of entries and understanding where the manipulation is happening. Because after manipulation, we are taking the real direction of the market, and there will be some very big moves like this one. Now, let me show you another example on EuroCAD. EuroCAD, 1 second. And this is funny because I'm showing this example, and it is a trade that actually hit my stop loss this week. I don't know when you will see this video, but this week I got a stop loss on EuroCAD. And the reason why, and I wanted to cover this in this video, it is really important, and it is a mistake that, as you see right now, I also make sometimes. Make sure to wait for the manipulation. I mean, you can enter before as I showed you, but the best option is to wait for the manipulation because in this case, which I will show you in a second, I thought that the manipulation happened already, but you need to be sure that it happened. I thought that the manipulation happened already. I thought that I was entering after the spring, but we really were not entering after the spring. It was just the spring didn't happen already. So as you can see, EuroCAD, I was bullish on higher time frames, so I will not cover for higher time frames analysis. We already did all the videos. So we were bullish on higher time frames. I was just waiting for the 5 and 1 minute to align to the direction of higher time frames in order to enter a buy. Went to the 1 minute, I found my, let me actually delete some boxes from here, some lines. All right. I was actually waiting for the market to align with my strategy, with the direction of higher time frames. So basically I saw the selling climax. Oh, sorry, in that case on GPAUD was the buying climax. Sorry for that. So in this case right here it was it is the selling climax. Automatic rally to the upside, automatic reaction, secondary test, and this secondary test, I thought that it was already some type of manipulation which is taking out these previous lows. So I was not really sure. This is my mistake. Of course, right now I will show you the correct analysis. So right here we have secondary test. Right here, sorry, we have the automatic rally. And then here we have our nice break of structure, as you can see. All right, perfect. So selling climax, automatic rally, secondary test, break of structure. So right now we know that we're bullish and we come back to our zone of interest. Of course, it was my mistake because I thought that this was the spring already. So I was entering on this retracement. I thought that this was the test of the spring. But if you see it, this is what happened after. There was this schematic right here, which is the selling climax, automatic rally, well, automatic rally in this case, secondary test, and then this move to the downside. This is the move that hit my stop loss. My stop loss was right here, hit by 1 or 2 pips, and then we just went straight to the upside. Now, I will show you the correct way to trade it. So we have the selling climax, automatic rally, secondary test. And in this case, as you can see, differently from the GPAUD, we don't really have a break of structure. Well, yes, we do have one right here. So this is the automatic rally, which is also a break of structure, which is breaking above this previous high. But let's see about the trend line. Let's see. Let me actually check the trend line. I'll put it from here. Right, yeah, perfect. So this is the automatic rally to the upside, which is also a break of structure. It is breaking the structure and it is also breaking the trend line. So perfect. Here, all right, secondary test. After the secondary test, what do we have? We have the spring. Perfect, spring. This is the manipulation that we were looking for. Of course, when we get this move to the downside, we don't know if it is a spring. We cannot enter right here. Maybe it is a real breakout and we just keep going to the downside. So don't enter when you see this, okay? All right, it will be very, very harmful for your account because sometimes we just have a breakout and we continue going to the downside. We understand that it is a spring once we come back. Right here, this might just be a retest before continuation to the downside. It might just be a break and retest before continuation to the downside. So we still wait. We wait for the retracement, come back up. Retracement, come back up. Right here, we are understanding that this is actually the spring. We just came back into this schematic. We are back bullish again, creating higher highs and higher lows again. And right now, we're just waiting for the right time to click the button and enter the buy. So we have the spring, we have the schematic playing out, fib retracement right here. This is the test of the spring, retest or test of the spring, as I said already. Entry right here. And this is a trade that I didn't take because for my rules, I took already too many trades for that day, and therefore I was out for that day. But of course, I was watching the chart and I knew that this was the correct entry, but you need to stick to your trading plan, stick to your rules. So entry, stop loss below the spring. This is 7 pips stop loss. Let's see for possible take profit. Well, I had the take profit, I remember, at 48.40 right there, and this is a 1 to 4.3. All right, and as you can see right now, well, it actually went more to the upside, so we could have gotten more, but of course we're happy with a 1 to 4. Now it is your choice. If you want to actually wait for the 1 to 10, you can do that. Just keep in mind that you will have more break-evens if you try to catch bigger moves, because maybe we retrace to the downside. So if you have any question about this, make sure to contact me. I hope everything's clear. As you know, you don't really need to know every single name of the schematic. In this case, also, we don't have the secondary spring, as you can see, because it is not that common, as I said already. As I was saying, you don't really need to know all of the names of the schematic, but as long as you know that you're waiting for a breakout structure and also breakout of the trend line, to understand that we are aligning with the direction of higher time frames. So in this case, breakout structure and breakout trend line, we need to use the two things together, as I mentioned in a lot of videos. After this, we are waiting for the manipulation, taking out the previous lows and grabbing liquidity for the big move to the upside. Manipulation happens, it is the spring, but we don't know if it is the spring already. It could be just a real breakout and a continuation to the downside. So we keep waiting. We come back into the schematic right here, creating also higher highs and higher lows. Maybe right here we were not sure already, but once we are here, there is enough confirmation that we came back into the schematic and that this was the spring. Wait for the retest, we enter, and as you can see, the market just takes off with really big moves to the upside. My friends, we got to the end of this video and I really hope that it was helpful for you, but I have a good news for you. Part 2 is coming very soon with the remaining part of this strategy. And part 2 is gonna be crazy because you're gonna understand even more pieces of the puzzle, actually some of the most important pieces of the puzzle, and put it together with this strategy that you learned today. So, I don't know when you're gonna be watching this, the video should be either available already or coming out in few days. So make sure that you stick by and that you stay ready for the second part, because this is really gonna change the game.